Today I'll be doing the continuation of the World International Trade lecture. So we start off with a little recap of what we did last week. So last week we looked at why we need to trade, as in we arrived at the decision to trade by taking a case study of Vestia and how the 3 colonies in the early civilization decides to trade through various goods and services that each country had an advantage of. Then we looked at international trade theories over the years and how those theories have been criticized and new theories have been developed. Then we came to the point where we discussed the creation of WTO, GATS before that, and the creation of WTO, and then we even looked at few clauses in TRIPS. So today our topics today are about the regulation of trade, how international trade is regulated through national and international mechanisms, and financing of international trade in slide 2. So to begin with today, before we get into the topics, I want you all to watch this little video which will serve as a recap or a summary of what we did last time, as well as a good introduction to what we are going to do today. So let's start by watching this now, which is a small, I think 6 or 9 minute video.
And I'm Jacob Clifford, and welcome to Crash Course Economics. Today we're going to talk about international trade.
So we all know our stuff is from everywhere. Bangladesh, China, Vietnam, China again. But what does it actually tell us about the global economy or the U.S. economy? And who's benefiting from all this trade?
And who's going to clean all this up?
Sorry. I think I mistakenly did the slide.
Hi, I'm Adrian Hill.
And I'm Jacob Clifford, and welcome to Crash Course Economics. Today we're going to talk about international trade.
So we all know our stuff is from everywhere. Bangladesh, China, Vietnam, China again. But what does it actually tell us about the global economy or the U.S. economy? And who's benefiting from all this trade?
And who's going to clean all this up? International trade is the lifeblood of the global economy. Basically, when a good or service is produced in, let's say, Brazil and sold to a person or business in the U.S., that counts as an export for Brazil and as an import for the U.S. As you might expect, the United States is the world's largest importer because Americans love their stuff. In 2014, Americans imported over $2 trillion worth of stuff like oil, cars, and clothing from countries all over the world. And if you look around your local big box store, it feels like everything is made in China. And we do import a lot of things from China, but in terms of both imports and exports, our largest trade partner is not China, it's Canada. The U.S. and Canada trade over $600 billion worth of goods and services each year. The U.S. imports a lot from Canada, but exports almost as much. In fact, the United States is the world's second largest exporter. It sells high-tech things like pharmaceuticals, jet turbines, generators, and aircraft to countries all over the world. It also exports intellectual goods like Kanye West albums and Pixar movies, as well as both commodities like corn, oil, and cotton. The annual difference between a country's exports and imports is called net exports. So if Brazil exports $250 billion worth of goods and imports $200 billion, then its net exports are $50 billion. That means Brazil has a trade surplus. In 2014, net exports in the U.S. were negative $722 billion. That's what you call a trade deficit.
Some people assume that having a trade deficit is inherently bad. Why does the U.S. import nearly all of its clothing? Why can't we clothe ourselves? U.S. producers could easily make more than enough clothing to keep all of us dressed. But they don't, because they focus on other things that they're better at producing. The U.S. buys clothing clothes from other countries because we can get them cheaper than if we made them here. This is the value of international trade. It doesn't make sense to make everything on your own if you can trade with other countries that have a comparative advantage. It's worth mentioning here that these savings sometimes come with other costs, especially for the people who are producing these goods overseas. Unsafe and unfair working conditions and environmental degradation can be ugly side effects of international trade, and we're going to talk about that. For today, though, let's get a handle on trade deficits. It can seem like exporting would make a country wealthy, while importing would make it poor. After all, if we buy products produced in other countries, then we're shipping jobs overseas, right? Well, only to an extent. Imagine that I have a choice of buying an American-made TV or a TV made in Malaysia. Because of lower labor costs in Malaysia, the imported TV costs $200 less than the American-made one. So I buy the imported TV. That may cost jobs at a TV factory in the US, but I saved $200 by buying the imported TV. And what am I going to do with those $200? I'm going to spend them on something I couldn't have afforded if I bought the US TV, like maybe taking my family out to a baseball game or to a restaurant. That creates jobs in those industries that wouldn't have existed if I bought the more expensive TV. Economic theory suggests that international trade reshuffles jobs from one sector of the economy to another, like from the TV factory to the restaurant. But the quality of these jobs can be markedly different. The guy assembling TVs at the US factory was probably making a lot more at his manufacturing job before he got reshuffled to the burrito assembly line at Chipotle, which is just to say all this is really complicated, and what is good in the aggregate is not necessarily good for individuals. For example, look at the North American Free Trade Agreement, or NAFTA. It was established in 1994 to drop trade barriers between Canada, the United States, and Mexico. Critics point out that NAFTA significantly increased U.S. trade deficits, and they say it decreased the number of manufacturing jobs in many states as companies moved out of the U.S. Proponents of free trade point out that the U.S. economy boomed in the 1990s, creating millions of jobs, including manufacturing jobs, and that free trade has decreased the prices of all sorts of consumer goods, from vegetables to cars. So despite the fact that some workers and industries were clearly hurt, economists would tell us NAFTA's had a net positive impact on all three countries. By the way, you know Thought Cafe, the makers of the Thought Bubble? They're Canadian. These graphics are imported. The debate over the value of specific trade agreements continues, but it's unlikely that the world's largest economies will return to strict protectionism. Protectionist policy, like placing high tariffs on imports and limiting the number of foreign goods, usually hurts an economy more than it helps. There are now several organizations designed to eradicate protectionism, most notably the World Trade Organization, WTO. The WTO has been effective in getting countries to agree to specific rules and help settle disputes, but it's also been accused of favoring rich countries and not doing enough to protect the environment or workers. Trade between countries depends on the demand for a country's goods, political stability, and interest rates. But one of the most important factors is exchange rates. Basically, this is how much your currency is worth when you trade it for another country's currency. And let's engage in some foreign trade now by going to the thought bubble. Suppose the US-Mexico exchange rate is 15 pesos to the dollar. If an American is on vacation in Mexico and wants to buy some sunscreen that costs 60 pesos, they'll have to trade $4 for pesos. Likewise, if someone from Mexico is on vacation in the US and wants to buy a $20 t-shirt, she will need to exchange 300 pesos for dollars. Now let's think about what happens if the exchange rate goes up to 20 pesos per dollar. Now to buy that 60 peso sunscreen in Mexico, it'll cost the American tourist $3 instead of $4. We say that the dollar has appreciated. At the same time, the Mexican tourist who wants to buy the $20 t-shirt will need 400 pesos instead of 300. It works the same way with imports and exports. When the dollar appreciates, it gets cheaper for U.S. consumers to import foreign goods, and U.S. exports to other countries get more expensive. U.S. imports rise and exports fall. On the other hand, what if the exchange rate fell to 10 pesos per dollar? Now to buy that sunscreen, the American tourist needs $6. Each dollar has gotten less powerful. We say that the dollar has depreciated. At the same time, the Mexican tourist who wants to buy the $20 t-shirt needs only 200 pesos. So when the dollar depreciates, foreign imports get more expensive, which makes them fall. And U.S. exports to other countries gets cheaper. Which ones they rise?
Most currencies like the peso and the dollar have floating exchange rates that change based on supply and demand. Like when the U.S. imports more products from Mexico, they exchange dollars for pesos. This will increase the demand for pesos, and the peso will appreciate. At the same time, the dollar will depreciate. Now, some countries have elected to peg their currency to another currency. This is when a country's central bank wants to keep the exchange rate in a certain range, and they buy or sell currencies to keep it in that range. The Chinese government was well known for buying U.S. dollars to keep the Chinese currency artificially depreciated. When the U.S. imported goods from China, the yuan would appreciate. Then the Chinese government would turn around and buy dollars, which kept the exchange rate about the same. This kept Chinese exports cheap for Americans. Up to this point, we focused on exporting and importing goods and services. But there's a whole other side of international trade that involves financial assets. Let's look at something called the balance of payments. It might feel more like accounting than economics, but it helps show how flows of money and flows of goods and services are opposite sides of the same coin. Every country keeps an accounting statement called the balance of payments that records all international transactions. It's made up of two sub-accounts, the current account and the financial account, sometimes called KIC.
Okay, so that was a recap of what we did last week, in that we took a case study and before we went into the theory, and we had a we got an introduction through that case study to certain concepts like trade deficit, appreciation and depreciation of currencies, then floating currencies, then protectionism, or the need to protect infant industries, and how a currency of one country was pegged and then it was allowed to free float, and how all of these things affected a country's ability to engage in international trade. And then we, like I said earlier, we looked into the theories behind all of these concepts, like absolute advantage theory, comparative advantage, then the protectionism mentality of the developing countries mostly, and how WTO was initially created to eradicate that protectionism mentality. So today we are going to look at, like I told you earlier, we're going to look at trade regulation. And in that, I'm going to give you a little introduction where you will be able to appreciate the usefulness or the negatives, the positive, the negatives of the trade barriers, and how best to navigate towards free trade. Now, WTO was, we discussed last time, WTO's main mandate and the reason for its creation was the need to eradicate trade barriers. But how practical that is, and what criticisms that WTO has come under, which had not allowed it to do that its duty as per its mandate, we discussed last time, and now today you can see the reasons behind trade barriers and how they are either desirable or undesirable, and how that really affects the mandate of WTO. Then we are going to take a peek at the complexities of international trade disputes that we are going to do through few case studies, which I'm going to read the case studies with you. I have taken these case studies out of the same book that I took the case study last time, the International Business Transactions 10th edition by Fitzgerald. So we are going to go through the case study, then we are going to discuss it. And in between these case studies, we'll take small breaks, so we do not exert ourselves in going about it. And then finally today, I hope to give a small introduction onto the financial instruments in international trade, specifically letters of credit. A small peek at that. So because this is introductory course, I don't think we need to go in depth. We just need to understand that the existence or the rationale behind each of these aspects of trade. So let's get down to it. So the regulation of international trade. The regulation is generally done through various means. Firstly, the regulation is done through national laws of each country. But of course, those national laws have to be in line or in compliant with the international trading agreements that the countries have entered into. So those trading agreements can be either bilateral agreements or regional agreements or simply international agreements. Now last week we looked at how WTO, how countries accede into the WTO and becoming members. It is by way of a contract. So each country contracts with the world body, the WTO, that when they become members, there is a list of things that each country has to comply with or has to enable within their own countries through national laws and legislation that would comply with the WTO's requirement of it would those regulations or those conditions would be to liberalize trade, to take away protectionism, and various things, various means of that we in each country enforce protectionism. WTO would give you timelines how and when you need to deal with that. So those would be various mechanisms that we would use to regulate trade. And when we say regulate trade, that would be regulation of imports and exports, because that's how we trade. And it's mostly imports. Now, we looked at last week, we looked at GATS, that is General Agreement on Trade and Tariffs. So that essentially concerns with trading in goods. Thereafter, GATS or GATS came, which is a general agreement in trading in services. Now, all of those agreements have certain requirements that each country will have to ensure that they adopt and adhere to in order to liberalize the trade barriers or move towards free trade. So what are these trade barriers? We keep hearing those things, and we keep hearing that this is the biggest obstacle in countries attaining that idealistic norm of free trade. I want you to, this is a small video that just gives you a preview as to what free trade is, and I'm going to go into theory thereafter. But here is a little introduction which I think would be useful for you to first listen to before we go in depth into the theory.
In video episode 34, we saw that the practice of free trade according to comparative advantage meant lower buying prices, higher selling prices, and greater global production, all of which means improved living standards. Do you know how many countries in the world are engaged in trade? Every single one. There's not one country in the world that's completely self-reliant. And do you know how many countries in the world practice completely free trade? None. Not one single country practices trade free of any restrictions. So if free trade is so fabulous, then why do all countries put restrictions in place? Perhaps it's best to take one step backwards and ask, who has the power to put trade restrictions in place? That would be each country's government. Why would the government put such restrictions in place? The government places trade restrictions in order to protect domestic industries from foreign competitors. Now ask yourself this. Which domestic producers would seek such protection? Surely not all of them. Some domestic producers already have a natural advantage in production over the foreign competitors. This is the key. The only domestic producers who would need protection are those who would be driven out of business under free trade, those who have a comparative disadvantage in production. So what arguments could the weak, disadvantaged producers make to the government to convince it to provide protection in the form of trade restrictions? Well, there are several. First, there's the domestic jobs argument. If some type of trade restriction, say a tax or a quota, is placed on incoming foreign goods, then consumers will have to purchase domestic goods instead, right? And if the demand for domestic goods is higher, then the need for workers to produce those goods is higher. Look at the U.S. steel industry. With protections in place, more U.S. steel is purchased and more U.S. steel workers have jobs. The domestic jobs argument is pretty persuasive with politicians because voters with jobs are happy voters. Here's the rub, though. While trade barriers mean more jobs in the protected industry, they actually cost jobs in other industries. Think again about the U.S. steel industry. Historically, taxes called tariffs have been imposed on imported steel so the U.S. producers don't have to compete at such a low price. But this means that steel will cost more to the consumer. Who buys steel? The auto industry, perhaps? Construction firms? Steel drum manufacturers? Any industry that uses steel as a resource will face rising costs, which will lead to decreased supply, which means fewer jobs in all of those industries. So while steel workers may have more jobs, workers in all the downstream industries, like auto workers and construction workers, will lose jobs. On net, especially in a country like the United States, where disadvantaged areas tend to be raw materials or low-end materials, this will result in a net loss of jobs. Argument for protection number 2, level playing field. The logic here is that the foreign producer has some unfair advantage of the domestic producer, and the trade restriction would just even things up a bit. An unfair advantage might be if, say, the foreign producer was receiving subsidies from its own government, such that costs were reduced and the foreign producer's product could be sold very cheaply in our market. But what happens if the foreign producer just has an advantage? Are all advantages unfair? In 1997, the collapse of the Thai baht kicked off a wholesale financial collapse in Southeast Asia. As Asian currencies lost most of their value, becoming very cheap, Asian products became cheap. Suddenly, U.S. steel producers were facing extremely cheap Asian steel and went to the U.S. government to seek protection. The question I have is this: did the Asian producers have an unfair advantage? Did they deliberately plan for their currencies to lose over 90% of their value just so they could sell more steel? The term fair is a slippery thing, somewhat subject to interpretation. The other difficulty here is that one country may dispute the fairness of another's restrictions and retaliate with restrictions of its own, eventually escalating into a trade war. A third argument for trade restrictions is that they can raise additional revenue for the domestic government. A tariff, or a tax on imported goods, will generate added dollars, as would revenue from the sale of quota licenses. But in a country like the U.S., where only a very small percentage of government revenue comes from traded goods, remember we saw in the budget episode that about 90% of federal revenues come from income tax, payroll tax, and corporate tax, does it make sense to harm consumers by making imported goods more expensive? The government revenue argument is likely to be more compelling for governments of poor nations where there isn't much income to tax. The only place to squeeze additional revenue is from businesses, especially internationally. A fourth argument used in favor of trade restrictions is the national defense argument. If an industry is critical to the national defense, we should protect it in peacetime to make sure that it's still around in times of war. Some industries may spring to mind immediately as being critical to the national defense. Tanks, guns, munitions, aircraft, shipbuilding. But then what about the metal used in all of these industries? Shouldn't that be protected? What about our food supply or uniforms for our troops? Or the producers who make buttons for the uniforms? You can see where this is headed. It becomes difficult to draw a hard and fast line separating industries that are critical to the national defense from those that are not. This becomes compounded when you realize that in recent years, the argument has been broadened from critical to the national defense to critical to the national interest. For example, some countries have restricted the amount of U.S. entertainment and publications, like movies and magazines, that are allowed in because they feel it would not be in their country's national interest to allow their own cultural identities to be swallowed up by U.S. pop culture. The infant industry argument is number 5 on our list. This says we should protect and support new industries until they're mature enough to compete on their own. I can understand this. In the town where I grew up, there was an economic incubator. If you had an idea for a new business, you could put in a proposal. If you're successful, you'd start up your business in the incubator building, enjoying lower rent and immediate access to business consultants. After a designated period of time, your business would move out and someone else would move in. Here's the drawback with federal support for a new industry. Who is in the best position to know when the industry is ready to leave the nest? The industry is. So if the government goes to the industry and says, hey, you ready yet? Can we take the restrictions away? What's the industry going to say? Sure, go ahead. More likely, the response will be, no, not yet. Ask us again in a couple of years. In the past, some countries would protect these infant industries for decades. In the U.S., at least, the International Trade Commission, or ITC, places time limits on protection and usually weans the industry off by progressively decreasing the level of restrictions over that time period. There is one more method that goes against the natural flow of free trade, but it's less about protecting a weak domestic producer from foreign competition than it is about giving your domestic producer an artificial boost into other countries' markets by subsidizing them so they can take over market share abroad. This method of creating international dominance is, of course, squarely in the arena of unfair advantage, see argument number 2, and it's really an open invitation for other countries to retaliate against you with restrictions of their own. In this episode, I went over many reasons why a government might agree to protect the economic interests of its domestic producers, even though they have comparative disadvantage in production. Next time, I'll show you in more detail how the government can protect domestic producers by using tariffs, quotas, voluntary export.
Right, so you got a little introduction into why trade barriers are necessary as opposed to free trade. So this little video that we just watched, it talked about 6 things actually as the need to create barriers. One is to protect domestic jobs, then to create a level playing field, then as a government revenue creation for national interest, infant industry protection, and export promotion. Now let's go into theories of trade barriers and try to understand how these concepts are put into action through various methods that we call as barriers. Now, in international trade, we identify 2 very distinct categories of trade barriers. One is called tariff, and the other is called non-tariff. Now, what is a tariff? Now, in this chart, you will see at least 3 different types of tariffs as export tariff, import tariff, and transit tariffs. And under non-tariff, we have categorized quotas, which we discussed last time, subsidies. We also discussed how Sri Lanka had a case at the WTO, which we ultimately won based on a rubber subsidy, and others like product testing, local content, currency controls, administrative delays, and embargoes. Now let's get a little more in depth into the theory of what a tariff is. A tariff is actually something that brings about a monetary loss for the party that seeks to enter into the market. In other words, for an importer, tariffs are taxes charged on import of goods from foreign countries. It's almost always tariff is imposed on imported goods, and very limited instances that tariffs are imposed on exportation, on exported goods. So again, tariffs are taxes charged on the import of goods from foreign countries. So while historically tariffs were used as a source of revenue for governments, they are now used mainly to protect domestic industries from foreign competition. So in the video earlier, we discussed how the US steel industry was benefited by the tariffs and how tariffs were imposed to protect that industry in the US. So even though tariffs in fact brought a certain revenue to the US federal government, the idea that kept those tariffs in motion for a long period of time is in fact to protect that industry. And that video also introduced you to how the United States government has various time limited or timeline for various industries in order to get them out of that infant industry status so they could go and compete freely in the world market. So then tariffs to protect the infant industries or to protect domestic industries from competition, they do this by increasing the price of an imported good by what you call a tariff or a tax in order to persuade the consumers to purchase domestic products instead. So, for example, if an imported car, now let's assume Sri Lanka manufactures cars in Sri Lanka, which we don't, but we have a very high tariff for imported cars, almost 300% of its actual value. We impose on, let's say, a luxury car like a Mercedes-Benz. Now, that tariff or that importation tax for a luxurious vehicle is imposed. One, it creates a revenue, an essential and a needed revenue for the government in terms of revenue collection. But it is also added for the importation of cars to discourage people from purchasing vehicles from abroad. Now, that would have been ideal if Sri Lanka had a car manufacturing mechanism of locally manufactured cars in the market, which would have been very much cheaper than the imported luxurious vehicles. However, we don't, but we still have that kind of very high and sort of very undesirable tariff on, or a tax on, the importation of luxurious vehicles. Now, here the example I took for you in the tariffs imposed on imported cars is an example that you could wonder whether that is in fact to protect a domestic product or a domestic industry, as the video presented to us about US Steel and what I'm telling you about in this theory. Because initially, so then we go back to that initial theory of tariffs being imposed to create government revenue more than to protect domestic industries. Now, in point 2, I have said that historically tariffs were used as a source of government revenue. So in Sri Lanka, clearly when we think about the tariff that is imposed on imported cars, we know that it is imposed as a revenue collection mechanism more than as a mechanism to protect an infant or a domestic industry in Sri Lanka. Now, a different example to this would be perhaps if there was a tariff imposed on something that we readily manufactures in Sri Lanka, and something like potatoes. Let's take potatoes. Let's assume that Sri Lanka's or pumpkins. Let's take pumpkins, for example. Sri Lanka has a very abundant industry or agricultural manufacturing, agricultural sector that caters to much more than what our people need in terms of pumpkins. So recently we saw how pumpkin growers or the farmers could hardly get any sort of profit in their harvest, and how the government had to intervene to sell those pumpkins for those farmers. Assume that somebody wants to import pumpkins into Sri Lanka from, let's say, USA, which has a pumpkin farms, and pumpkins are sort of a very sought after kind of vegetable in terms of cooking, and also that during Halloween, pumpkin is almost an essential good. So let's assume that somebody in Sri Lanka wants to import pumpkins. Now at that point, if we imposed import taxation on the importation of pumpkins like we have done for cars, like 300% of its actual value, now that would be a tax that we can categorize under point 3 here as a tariff that is imposed that would increase the price of the imported pumpkins as a measure to persuade our people to buy locally and not the imported goods. So in that sense, that tariffs can also act as something that is a deterrent to imported goods. So this is why we say that tariffs are a trade barrier that goes against the whole idea or the concept of free trade. Now, governments can use many tools to affect the equilibrium prices, that means the balance of prices of traded goods and the quantities of traded goods produced and consumed. So if the government, in most cases, such intervention involves restriction of imports, but governments also tax or subsidize exports. So governments can do this in two different ways. Now, if we take the pumpkin example, the intervention that the government has made by imposing a 300% tax on the actual cost of a pumpkin is to restrict the importation, because nobody will want to spend so much money to buy a pumpkin which is readily available in Sri Lanka at a fraction of the cost of the imported one. So there will not be a market for that in Sri Lanka. So that would be a tariff that is imposed to restrict imports or to discourage imports. But in a different sense, the government can also try to achieve that by taxing or subsidizing exports. Now, that's what our government has done some time ago with our rubber. Now, Sri Lankan government knows Sri Lanka is leading, if not the number one, but a leading manufacturer of rubber to the world in different areas, like for airline tires and motor vehicle tires and things like that. Sri Lankan rubber is sought after. So how can the government ensure that the Sri Lankan industry is protected in the international trade or in the international market for rubber? Our government can give our rubber industry what we call a subsidy. Let's say it's for fertilizer. Rubber trees need to be fertilized, let's say, every 3 years. So the manufacturers of rubber or the growers will face huge costs in terms of fertilizing. The government can step in and say, okay, the revenue that you bring into the government or to the country in terms of exports of rubber is so significant that I think if you have to invest so much money for fertilizer, that will counter that profit that you bring into the country. So we are going to help you with your fertilizer cost, and we are going to provide you fertilizer through the government at 50% of the market price that you can buy from us, and you don't have to buy from the market. So that is a subsidy that you provide to that industry. So that's another way that the government can use to put a barrier into free flow of international trade. Then the tools of import restrictions, tariffs, we have various names for tariffs. The tariffs can be very specific or ad valorem. Now, these terms are used internationally, and those are terms that the international trade, sort of the markets and the international trade organizations recognize as barriers, but sometimes barriers that are essential. So for example, we have in customs, internationally recognize a customs harmonized code that we apply for each country. If you say harmonized code, HS code, 1701, somebody would know that anybody would know around the world who has subscribed to those international standards that refers to confectionaries or sugar, something that like, chocolate or sweets and that kind of candy goods. So if a country is imposing a tariff or a tax on that confectionery, in your tax regulations, for example, in Sri Lanka, the gazette that the minister publishes imposing a tax would refer to the tax as HS code 1701 point, let's say 10, let's say that's lollipops, and every lollipop will be subjected to a 10% tax of its maximum retail price, something like that. So it is not necessary for each country to specify on what goods that they impose a tax in terms of words, but that they could do that in terms of very specific, universally recognized code, which is accepted all around the world. So tariffs can be very specific or ad valorem. Then quotas or voluntary export restrictions. Last week we talked about quotas in our case study, how we will give now, for example, GPS, General Products and Services quota that we get from the European Union for our garments. So that is a way that would restrict free trade in a certain sense by giving us as a developing country an advantage over somebody else who doesn't get this kind of advantage to enter the market in Europe in terms of garments. So that is a quota, or we call it a voluntary export restriction. Then regulations. Now, in Sri Lanka, when we, let's say a Sri Lankan rubber manufacturer is trying to enter a market in US can restrict our access to the US market by requiring our manufacturers to go through a certain testing mechanism of our product. For example, they could say, you have to have a certificate of a testing certificate issued by a lab in Vietnam that has these certain standards and a lab that is recognized by the US government before you can enter to our markets. So that is, in other words, it is also a barrier that we have created to freely engage in trade by everybody on a level playing field, and that is quite rampant in the world. And every day, international trade requires so many testings and laboratory certificates and things like that. For example, for the importation of oil, for the importation of metal, and for importation of food and beverages and things like that. So that is also identified in the world as a barrier to trade. And then customs has various regulations, but in the world there is a customs body that regulates these various sort of barriers or obstacles that are essential, but also that are cumbersome for people to enter various countries' markets. But there are very good reasons, like we understood through the video earlier. Then certain labeling requirements and domestic content requirements. Now, that means for certain countries, for certain products to enter their market, they will not permit an entirely foreign-made product unless it has something to do with the country's manufacturing sector. Now, that kind of, for example, let's say a lollipop will not be permitted for importation into Sri Lanka unless that lollipop, before it hits the retail market, like before it goes to the supermarket, it had some sort of value addition in Sri Lanka. So how do you do this? For example, if you are going to bring a lollipop for sale in Sri Lanka, Sri Lankan government will permit that, subject to the fact that that lollipop has to at least be wrapped and, you know, maybe the stick attached in Sri Lanka, or it could be wrapped in Sri Lanka, some sort of manufacturing process which would have created certain number of jobs in Sri Lanka that we can accept the need for importation of that kind of good. So most of the time, this kind of domestic component requirement or domestic content requirement is a trade barrier in things which are non-essential goods, which we understand as non-essential goods. There are certain things you would have studied through other courses, which we identify essential goods and non-essential goods. So for non-essential goods, when you try to enter into a foreign market, there is a, I would say, a higher threshold in barriers as opposed to essential goods. Now, who pays tariffs? I told you tariffs are essentially taxes, or it involves pricing or money. that is going to cost the ultimate buyer a higher price to pay for that good than any other good that is locally manufactured. So in general, the importer pays the tariff. That means the person who is importing the goods. Now, for example, somebody who imports shoes from China to Sri Lanka will have to pay that tariff at the entry point to the country, that is customs, as customs duties or duties collected by customs at the port of entry. So it is the importer who pays the tariff, and tariffs are collected nationally by the customs authority of the country into which the goods are being brought. So your question then would be, doesn't the ultimate customer pay that tariff when they are purchasing that good? Well, we do, because what tariffs do is, tariffs essentially increases the ultimate price that we can buy that good at. So, for example, if pair of shoes, pair of female slippers in the market, if it's locally manufactured, could be 300 rupees. But if it is something that we have imported, let's say from China, it could cost 500 rupees. So it's a 200 rupee increase that we will have to pay if we are going to buy the imported product. So people buy the higher value product if they see a certain, a quality requirement, a higher quality in the product than the locally manufactured product. And various reasons people want to buy certain imported products as opposed to domestic products. So here again, we are going to touch on that earlier concept of how the tariff was imposed to protect the domestic industry. So for example, somebody who sees the 300 rupee locally made female slippers would feel, okay, I would like to buy the lesser priced one, and that way the locally priced good gets to be sold where in the market, which is where it is laying side by side, as opposed to the imported 500 rupee slipper versus the 300 rupee slipper. So those again are examples to highlight to you that how the tariff or the monetary value that is added to an imported good as a barrier to trade, in fact, discourages or poses a threat to free flowing of international trade, as if there were no boundaries between countries. Now, exporters do not usually pay the tariff as such. Rather, they experience adverse effects from their products being made more expensive on the foreign market. This means they may have to cut their prices to remain competitive. Now, earlier we discussed about Sri Lankan rubber trying to enter the American market. So we do not, our manufacturers need not pay so much at the customs at the US as a person who actually, a US citizen who imports rubber, but because we have to compete with other locally manufactured products in the US, we may not be able to make such a huge profit as we would want to, because we would have to make sure that our profit margins match those that are there already in the market. For example, we can't try to sell a pair of rubber slippers in the US markets for $5 if the locally produced one is being sold at $3. In that sense, if the Sri Lankan government gives a subsidy to the local rubber manufacturer, then his cost of production would be low. So he can agree to a low profit margin. He can agree to a price that is as close as the US manufactured slippers that is being sold at $3. So maybe we can sell our product at $3.50 or something like that, where we don't feel the difference so much just by being an imported product into that country. So how are tariffs charged? Almost all tariffs are set as a percentage of the value of goods in question. Some agricultural tariffs are set in relation to the weight of the product. For example, a kilo of pumpkin, rather than the value, rather than the actual cost of growing a pumpkin. There are also more complex tariffs that combine a percentage and a per kilo charge. These apply to highly sensitive agricultural products such as beef. Others still are based on weight of a specific ingredient used in the product. For example, the tariff of a chocolate is based on part on the weight of its sugar content. Now, let's just take the last point. Now, we talked about the exportation or importation of beef. Now, we know that in the world there is something called a craze for this certain type of beef that is mostly manufactured in Japan, in a certain province, Kobe. It's called the Kobe beef, where the cows are known to have, cows, they listen to music, they get massages, and they get special kind of treatment. And then there is this niche market in the world for this Kobe beef, where you should check that in Google. Actually, they have videos on these things. I myself had a chance to taste Kobe beef, which actually do taste different than any other, meat that you've eaten. So that Kobe beef has a certain reputation that, despite it being very highly priced, even in Japan itself, and when it tries to enter into, let's say, the US market, it is clearly and obviously an item that is at least, 10 times more expensive than the ordinary beef that is homegrown in the US. So for that kind of product, the tariff system would be more complex. It is not just going to be a tariff that is imposed on its weight. The third point here is it is a tariff that is a combination of the percentage and per kilo charge. So there are two different ways that the US government will be trying to discourage importation of beef into the US from Japan. It's not only by imposing a tariff on a per kilo charge, but on a percentage wise of also. So I told you earlier, for non-essential goods, each country will decide whether they want to flood their market with non-essential goods and let them compete with their own products, or whether they want to discourage the importation of these non-essential goods. So they will resort to various means of imposing these tariffs as a barrier for free entry into their countries. So restrictions on tariffs. The ability of a national government to set tariff is restricted by international commitments. Now, I started off my presentation by saying how the World Trade Organization was created with the intention of discouraging barriers to trade and encouraging free trade or free flow of trade. So most of the time, when we accede to International Trade Organization, we contract, not most of the time, all the time. Each country will have to enter into certain contracts or agreements where we tell the world body that as a member of the World Trade Organization, we will now seek to bring down these barriers to trade or for free trade in our country. And we will do it by this way. So if you study the accession of China, which happened in, I think, in 2001, if I'm not mistaken, the China accession to WTO is a very detailed process and a process that a lot of people have written about, and it's a lot of articles are available online and in books. There are many books written on this topic of how China needed to do certain things internally through domestic legislation and domestic policy changes and get in line with adhering to the international commitments that the WTO contracts or agreements would send it their way. So most major trading nations are members of the WTO and so are subject to obligations in its general agreements on tariffs and trades, or GATS. Now, you will hear that there is a so-called trade war between China and US. Now, these things become trade wars when each country, for example, when US tries to go against their WTO agreements and their undertakings and obligations towards China specifically. They target China and then they say, okay, I'm going to impose this kind of restriction on the importation of Chinese toys, or let's say Huawei phones. We are going to completely ban Huawei phones from entering into US. And that is what has happened now. And then China will note that that is not the agreement that US has with the World Trade Organization in liberalizing their trade barriers. And China will make their case at the World Trade Organization. But they won't just wait like that. They will also reciprocate by imposing a barrier to a certain US good, which would operate as a barrier for trade of US goods, US manufactured goods coming into China. So these, even though in theory there is are trade barriers, or the trade barriers that countries can impose on each other is restricted by our obligations. I just gave you an example how in practice certain powerful countries can sometimes overlook those international obligations and create bilateral sort of barriers between two countries that are not in good terms and restrict free flow of trade between those two countries, especially if it's countries like United States and China. That kind of barriers has a ripple effect on other lesser developed or other developed countries that rely on good relations between US and China. Now, we talked earlier about how GATS, or Goods General Agreement of Trade and Tariffs, is the mechanism that WTO uses to ensure that barriers are brought down. Now, how is this done? Through international agreement. What type of provisions that international agreements have to bring down national barriers? One of it, number one, is the most favored nation treatment, or MFN obligation. WTO members must charge all other members the same tariff unless they have a free trade agreement with them. This is often referred to as a trade-in on WTO terms. For example, now Sri Lanka cannot have a 30% tax on sugar imported from Brazil, whereas we have a 10% tax if it is sugar imported from, say, Zimbabwe. If Zimbabwe, Brazil, and Sri Lanka are all members of the WTO, Sri Lanka must ensure that the taxation for sugar imported from Brazil is the same taxation or tariff that is imposed on sugar imported from Zimbabwe. So if Zimbabwe is getting 10% only taxed at the point of entry into Sri Lanka for its sugar, a Brazilian sugar exporter can complain to WTO that Sri Lanka has extended a favorable treatment to Zimbabwe, which has not been extended to Brazil. And that would be a cause for dispute. Now, how can this be avoided? Is if there are free trade agreements between two countries that the WTO agreements will provide, you can have a differential treatment as agreed by two countries that you can legally sidestep the WTO contract. Now, for example, Sri Lanka and Singapore has a free trade agreement. Now, Sri Lanka can give a Singaporean exporter of, let's say, a mobile manufacturer, a tariff which is more favorable to him than we would give to a Chinese manufacturer. We can, for example, we can say that a mobile phone of, certain specifications that are made and imported into Sri Lanka from Singapore will only be subjected to a 20% tax of its cost of production. Whereas if a mobile of same specifications is imported from China, we will tax that product 30%. as a tariff or an importation tax. So there is a discrepancy. However, the Chinese manufacturer cannot go to World Trade Organization and complain about that because Sri Lanka has a special agreement called the Free Trade Agreement between Singapore. So in other words, a free trade agreement or a regional trade agreement or a bilateral trade agreement is an exception to the otherwise mandatory rule of most favored nation treatment. Now, a second way that the GATS impose restrictions on trade barriers is that WTO members must not exceed the tariff rates they have committed themselves into their schedules. Essentially, long tables of tariffs itemized by type of goods which members submit on joining to WTO. So at the point of acceding to the WTO treaties or becoming a WTO member, each country is required to give a long list of tables of tariffs that we are going to charge on certain goods. And this table can change from time to time, but it is an agreed document. For example, if Sri Lanka, when we acceded to WTO, when we became its member, had told WTO, look, at any point in time, we are only going to impose a 5% tax for rice imported into Sri Lanka. Now, say 20 years later, if Sri Lanka has not amended that, Sri Lanka cannot impose a 20% tax on imported rice just because we have a higher harvest in this year. You know, purely because these tariffs or these tables of tariffs at the point of becoming a member of the WTO is a result of a long negotiation process. The country that seeks to be a member of the WTO sits down with the members, with the officers of the WTO and its nominated members, and go through a long process of negotiation, how to bring down trade barriers and when to bring down the trade barriers, and how we can legally charge certain tariffs for whatever purposes we want to charge on, for government revenue or to protect industries. And they are considered as the agreed norm. Now, if you go and charge a tariff which is higher than what you have mentioned in your agreed table, that will not be tolerated by WTO. So these maximum tariff rates are called bound tariffs. When WTO members choose to apply tariffs below their bound rates because they consider that a lower tariff rate would benefit their economies by encouraging trade. So we can always go below the rate that we have agreed to. We can't go higher. Thirdly, most countries also choose to sign FTAs. Now, I talked about that in the first point itself, to sit on top of their WTO commitments. Once a country has signed an FTA, the tariff it can charge on imports from its partners or various occasionally partners are limited to the levels prescribed in that agreement. But it will continue to charge its standard WTO tariffs on imports from countries with which it does not have an FTA. And that's what we talked under the first point as well, as an exemption. Then countries or trading blocs can also have customs union. You know, European Union is the world's most efficient and productive and long-standing customs union that we have in the world. In general, there are no tariffs on movement of goods between members of the customs union. So if you're importing milk to France from Germany, there are no tariffs imposed on that importation. So basically, a customs union will promote free trade among its members. And a common tariff is placed on import of goods from outside the union. So, for example, in the same example, if there is no importation tax for milk that is imported to France from Germany. However, if milk is imported from United States into Germany, let's say Germany has a 5% tax on that, then France must also have a 5% tax on the milk imported to France from United States. They cannot make that a 2% tax, because a 2% tax would mean that France has given preference to the US milk that is imported into France and allowed that to compete with the milk that is imported from Germany. And therefore, the German milk manufacturers will face undue or will face competition which does not amount to a level playing field. So a customs union can have its own laws on regulations, and that even if it goes against the WTO contracts will be permitted, because those regional blocks, trading blocks, and their laws will supersede the WTO regulations. Then there are things called non-tariff barriers. I told you in our first slide earlier. Here, barriers to trade are mainly categorized under two different headings. Tariffs, we just talked about export-import tariffs, and then non-tariffs. What are non-tariff barriers? Non-tariff barriers, or we refer to them as NTBs, refer to restrictions that result from prohibitions or conditions, or specific market requirements that make importation or exportation of products difficult and or costly. So they need not manifest themselves as a tax or a financial obligation. They can be just a mere condition or a restriction or a prohibition that make it difficult for you to enter into a foreign country and enter its market. NTBs also include unjustified and or improper application of non-tariff measures, such as sanitary and phytosanitaries, SPS, we call them SPS measures, and other technical barriers to trade. We can look at those in the form of examples in a bit. So NTBs, or non-tariff barriers, arise from different measures taken by governments and authorities in the form of government laws, regulations, policies, conditions, restrictions or specific requirements, and private sector business practices or prohibitions that protect the domestic industries from foreign competition. So the main aim of NTBs, or non-tariff barriers, is to protect domestic industry from foreign competition. Now, let's see how this is done. For example, import bans. Sometimes countries enforce complete and 100% ban on importation of certain goods into their countries. So that will not be to protect the domestic, that will not be to, in the same means of a tariff barrier, which if you had, where you provide entry subject to a certain charge, which will be government revenue. Here you import a certain ban, a complete ban of importing a certain good into a country. For example, let's say your Thailand has Indonesia, let's say it's a Muslim country, and they have a complete ban on importation of foreign liquor, for example. I'm not sure whether this is true. So that could be for different reasons, for cultural reasons, for security reasons, or we had that example in that earlier video we watched, where certain countries have a complete ban on foreign magazines, certain type of foreign magazines, because they feel those magazines will be a threat to their cultural and traditional values. So then other ways of imposing or examples of non-trade barriers, general or product-specific quotas. So I told you earlier, for the Sri Lanka has a quota system, or GPS, we call it GPS, system for entry into the European Union for our garment industries. So that is a quota that we impose. We don't allow any amount of Sri Lankan manufactured garments into the European Union. They will say, okay, for this month, Sri Lankan quota for garments for the entry into the European Union would be, 10% of total requirement. So likewise, 10% for Sri Lanka, maybe 20% for Bangladesh, or 30% for Vietnam. They will have various quotas. So all our manufacturers, their products domestically, they will have to agree on how they restrict their exports within that 10% quota. Then complex discriminatory rules of origin. Certain countries try to impose barriers on the basis of where that product originated from. Now, for example, say United States is at war with Iran, and United States does not want to trade with Iran, but it does not want to impose a direct ban on Iran in a very, which would lead to sort of a reciprocity by Iran towards the US. So what they would do is do it in an indirect way. They will say, yes, if Iran's, pistachio grown in Iran, but let's say pistachios are grown in a region in Iran but taken to Iraq and they are de-seeded there and packed and exported to US. US can, let's say US allows products that are manufactured in Iraq to enter freely into the United States. But since they do not want to trade with Iran, they could say, if the origin of the product is from a country that falls within this list of countries where we have banned trade, that product cannot be accepted into the United States. So even if the ultimate product is shipped from Iraq to US, if the pistachios have their origin in Iran, that will be prohibited. Then unjustified sanitary or phytosanitary conditions, or we call it SPS. So these are again certain mechanisms that countries use. This is a very complex area and something that leads to a lot of negotiations between countries. When we were negotiating the Singapore Free FTA, these things were negotiated by the officers of the Department of Trade at great length, where countries have various issues in permitting certain goods to enter into their countries if they feel that those goods have not been created or manufactured in a sanitary environment. Then unreasonable and unjustified packaging, labeling, product standards. So now an area that is growing is environmentally sustainable packaging. So if a country feels that this kind of goods, if they are imported in polythene packaging, can lead to environmental pollution in our country, we will not permit that kind of packaging. So if your goods are in that packaging, we will not permit it to enter into the country. And then complex regulatory environment. So for example, let's say sweets manufactured in a certain country is being brought into Sri Lanka. Before they enter Sri Lanka at the port, they must produce certain food regulators certificates that say that these are safe for human consumption. Those certificates must be obtained by the importers before these goods are imported into a country. So that itself is seen as a barrier for international trade, even though it is an essential thing for most countries to do. Then determination of eligibility of an exporting country by the importing country. And likewise, all of these things you can see I have listed down a very detailed list of how, for examples of non-trade barriers. You can read it for yourself and have an understanding. I don't think we have enough time to go through everything. So at this point, I think it's good to take a break before we launch into these case studies. And in these case studies, I'm going to take a case study each that covers these 6 aspects of where you can see how trade barriers are imposed in various ways that prevent or that create obstacles for parties or companies or countries to trade with other countries, and how these case studies are drafted in a way where it has considered you the reader as a counsel or as a lawyer who is called upon to advise these companies on how to work their way around these trade barriers and enter into these markets and these countries. So let's take a 10-minute break. Now it's 10 to 3. Let's meet at 3 o'clock and then we'll continue with this case study. Hi, so welcome back. So now we will go into the case studies one by one. So I hope you can read this. I'm going to read it with you, so it will be easier for you to understand if it is not clear, or take notes. So I'm going to read the first case study, and this is, like I said earlier, a case study on MFN. We discussed a little while ago that MFN is a mechanism that WTO uses to ensure that trade barriers do not impact on free trade. So let's see. I hope it's clear. I'm going to start reading from the book, and then you can read along with me. The World Trade Organization, Oxycorp, trades with non-market and transition economies. The setting: Oxycorp Incorporation is a medium-sized United States corporation that traditionally specialized in trade with countries possessing non-market economies, NMEs. Since free market principles are increasingly being recognized and adopted around the world, clear-cut NME nations are getting hard to find. Oxycorp has therefore had to adapt to what are known as transition economies, or TEs, in countries seeking to shed their NME status. For example, many of the former Soviet Union states and much of Central Europe are in differing degrees of transition to a market economy. China also is progressing rapidly along the market economy learning curve. This is especially important to Oxycorp since over half its business is with People's Republic, that is China, and it has been involved in a lot of tariff and trade disputes with PRC. All of this change has been rewarding to John Oxman, the founder of Oxycorp, who has long believed that the best policy of the United States is to trade with all countries so that they ultimately recognize that the market system is better able to improve quality of life. Oxman also believes that economic interdependence is the key to world peace. Oxycorp understands that the United States, principally through its obligations under the GATT, has extended more favored nation MFN tariff status to over 150 nations. MFN tariff status is more accurately referred to as normal trade relations. As a result of a series of GATT negotiations since late 1940s, the average MFN tariff rate on dutiable manufactured imports into the United States has been reduced to below 4%. This is remarkably low level when measured against the tariffs applicable to goods imported into US from some NMEs. Such goods can be subject to Smoot-Hawley Tariff Act of 1930, the source of some of the highest tariffs in the United States history. The General Counsel to Oxycorp is anxious about the level of risk the company faces in continuing to trade heavily in goods from NME and TE countries. The General Counsel has asked you, a junior staff attorney, to prepare a memorandum of law detailing what US tariff levels apply to which goods from NMEs and TEs and why. The General Counsel also wants to know what are the prospects and conditions for changes in US tariffs as applied to goods from these countries? And in particular, whether the emergence of the World Trade Organization in 1995 will make a difference in tariffs and other trade disputes, like the ones it has experienced with China. So, we will go into the discussion of this case study and how you should focus. Now, you have been asked a question by this company as an attorney, or imagine yourself as a junior lawyer, to prepare a memorandum of law detailing what US tariff levels apply to which goods from NMAs and TEs. Now, in the third paragraph, you read that United States has entered into GATT and has extended MFN tariff status to 150 countries. And MFN tariff status is more, as a result, the series of GATT negotiations since 1940s, the average MFN tariff rate is below 4%, which is remarkably low level when measured against the tariffs applicable to goods imported to US from NMEs. So Oxycorp is essentially a company that deals with NMEs or non-market economies or transition economies. Now, after transition, you would assume that they will be part and parcel of the WTO, and then the tariff rate that you can impose on these goods coming from these countries would be significantly lower for this company than it is now. So they are getting a little concerned and the risk level of the company facing these countries going into transition. So they had asked you to prepare a table where it shows that the goods that you import and the tariff level, so they can make a decision on that. Now, how do you approach that? Well, this book also allows us to have an idea on how to focus on this kind of problem and apply the knowledge we know. So I will read to you out of the book on the areas of consideration that we should take on board. So it says the meaning and significance of most favored nation status is a fundamental concept of international law. We already discussed the MFN. Every nation or custom territory has several levels of tariffs for imported goods. The goods of some nations may not be allowed as imports, or the tariffs are set so high so as to effectively cause the same result, as in the case of NMEs. Not to trade with another nation is a political decision. Now, we discussed earlier also about Iran. I took examples of Iran and US and how US might not want goods coming in from Iran. And those reasons are not based on logic or, mathematics or percentages and things like that, but they are political decisions that the rulers of each country take based on the mandate that they are given by the people. At the end of the spectrum, some goods or goods from some nations may be admitted without any tariff, called duty-free. And this special treatment may be accorded certain countries because they are part of a free trade agreement or customs union, like the European Union we discussed about earlier, or because they are goods from less developed nations with special relationships. And also, some of the developed countries trade with very poor African countries, and they permit certain goods coming from those countries on a duty-free basis as a means of encouraging these countries to trade internationally, which they would not be able to do otherwise. But for most trade, the tariff level set for particular products is the same for almost all nations. This is what we call most favored nation treatment. That sounds as though we single out some very special trading partners for most favored treatment, but it is not the case. Most favored nation treatment is really, or at least ideally, it is a norm. Even though the term most favored nation seems to imply that you're going to favor one party, it is actually the opposite. It is a standard that we give to everybody, except, so that is the norm or that is the rule, and the exception is to give one or two countries certain preferences on certain accepted principles. One issue in the context of this problem, to which the GATT addresses problems of non-market and transition economies. Some nations such as China, admitted to World Trade Organization in 2001, and Vietnam, admitted in 2007, are already GATT signatories and World Trade Organization members, while others such as Russia and Iran wish to join. Determining the terms and conditions for membership is not easy. At the time of drafting the GATT agreement, the uniqueness of trading with NMEs was not extensively considered. And little in the 1994 WTO agreements address transition economies. Now, membership in the WTO matters on a wide range of trade law fronts. MFN tariffs negotiated with the WTO determine most national tariff levels, including US normal or MFN tariffs. Now, we discussed earlier how that table that we submit to WTO at the point of joining WTO determines how each country can thereafter impose tariffs with other countries. With only a few exceptions, WTO membership is a package deal, binding each country to roughly 30 distinct trade agreements. For example, the WTO package includes agreements on agriculture, textile, services, intellectual property, and government subsidies. All of the WTO agreements are linked to the dispute settlement understanding, sorting out WTO dispute settlement process in major focus of this problem. So here, what I've just read to you is, you can take down notes later on and try to arrive at this. Now, this is a hypothetical case study, but basically what I just read to you is the areas of focus of consideration that you should address your mind to when you are applying the theory that you learned into a practical problem like this. So with that, we will move into the second case study. These are all short case studies to show you how the theory that we learn how that has to be applied and how problems come our way, which require us to dissect the problem and be able to see how the trade law principles and theories and concepts that we learn can be applied in solving these problems. Now, the second case study that I have given is about customs classification, where I told you we are trying to address tariffs in this case study. In your slide number 19, I have told you which area this case study will be addressing. So here is a case study that will touch upon customs law, product classification, and valuation and origin. The setting here: Fast Food Incorporation produces lines of food that can be spread on bread for meals, which are quick, easy, and nutritious. That is their marketing line. One of its spreadables is PB&J, a combination of peanut butter and jelly, which is swirled together in a jar for instant spreadability. PB&J allows the customers to avoid spreading its constituent elements separately, and it also allows easy use of the combination with a single piece of bread. It costs fast food about 55 cents to produce a kilogram of PBJ. Double Happiness is a Chinese company which produces peanut butter and jelly swirls in China for export. Double Happiness has proposed that it seeks to sell the peanut butter and jelly combination to fast food for resale in the US market. For small amounts of the combination, Double Happiness price would be 50 cents per kilo. But for orders over 250 metric tons, Double Happiness's special price for large orders would be 40 cents per kilo. This price would be for delivery, CIF, fast foods plant, on the United States West Coast, but exclusively for any import duties. Alternatively, double happiness price would be 40 cents per kilo FOB Hong Kong for small orders, and its special price for large orders would be 30 cents per kilo FOB Hong Kong. Freight and insurance costs from Hong Kong to US are estimated to be 10 cents per kilo. As a third alternative, Double Happiness would be willing to establish a sales office in the United States and would sell from the office to fast food for 50 cents or 40 cents per kilo, plus an import duties assessed by the US Customs. The executive at fast food are interested in obtaining supplies at less than 55 cents per kilo that it costs to produce PB&J in the United States. A reduction of 50 cents or 55 cents per kilo would be useful, but a reduction to 40 cents per kilo would be spectacular. They have asked you to research whether there are any applicable import duties or any import laws which would cause problems with purchase from Double Happiness. Your client wants to know what the amount of the tariff duty will be on such goods before signing a purchase contract, rather than after the goods have arrived in the US. So what is your advice? Incidentally, there is a rumor that the peanuts in the Double Happiness product originates in Philippines. The rumor is ambiguous as to whether China imports just the peanuts from Philippines or whether it imports the processed peanut butter. These rumored facts make any difference? Now here is a case study where you get to use most of the concepts I discussed with you earlier in the theory about rules of origin, about tariffs being different from country to country, and how rules of origin will also determine the tariff applicable to the end product. Now, how do you focus, or what issues should you address your mind to prior to answering a problem like this? So I'll give you a small areas of I'll give you a small read up on where you can take notes on how to approach a problem like this. So to calculate an import duty, as you are asked to do by your client, you must first determine the classification of the goods. I told you HS code, then country of origin, and customs valuation of the goods. So those are the three things that you need to do if somebody asks you to calculate the applicable import duties of a certain product. The inquiry by fast food raises several different issues. One, classification of the product category of the peanut butter and jelly swirled together. So it's not, now your classification of the good is not peanut butter or jelly, and it's not just peanut butter with jelly, it is peanut butter swirled and jelly swirled together. So it has to be swirled together as well. Then two, identification of the place of origin of the product shipped from China. So the goods that have been shipped out of China, is it originally produced in China, or where did it originate from? Is your second objective. And then third, valuation of the peanut butter and jelly in regard to both freight and other charges. So that would be a huge, the costing factor for your tariff, valuation of peanut butter and jelly in regard to both freight and other charges. Although these issues are interrelated insofar as your advice to fast food is concerned, they initially require separate analysis. Now, you might see one overlaps with the other on what I told you, but everything requires a separate analysis. The basic tool needed for this analysis is the Harmonized Tariff Schedule of the United States, or HTS. HTS was enacted by Congress as part of the Omnibus Trade and Competitive Acts of 1988 and became fully effective in 1989, repealing the older tariff schedules of the United States. So in each country, there may be a harmonized tariff system where when you get the document to your hand, it has all the tariffs on all the imported goods found in one document. So that's your first go-to document. The HTS provides a hierarchical structure of nomenclature used to describe the goods, rates of duty, and statistical reporting requirements for imports into the United States, and is maintained by the International Trade Commission. So in Sri Lanka, it would be maintained by the Trade Ministry or Ministry of Finance. Department of Commerce in Sri Lanka comes under the line Ministry of Finance, so you can find these documents in the Ministry of Finance website and also Customs website. However, the Bureau of Customs and Border Protection of the Department of Homeland Security is responsible for interpreting and enforcing the HTS. Now, in most countries, including Sri Lanka, the importation taxes are collected by the border authority or the customs. Now, even in Sri Lanka, even though there may be duties that are imposed by the Inland Revenue or the Consumer Affairs Authority or the Export Development Board, all those duties are collected by the duty collection agent, which is the customs or the Sri Lanka customs. It is the same in the United States for this example. The HTS nomenclature structure is in turn based upon an international system formally called the Harmonized Commodity Description and Coding System, the Harmonized System or HS. Now, I talked about the HS code earlier with you, and that is the reference that I'm reading out of now. Established under the International Convention on the Simplification and Harmonization of the Customs Procedures, or the Kyoto Convention, and administered by the World Customs Organization. The World Customs Organization was established in 1952, and the Customs Cooperation Council, and is an independent intergovernmental body whose mission is to enhance the effectiveness and efficiency of customs administration. So, most problems of product classification arise when it is possible to classify the imported goods under more than one heading in the HS code. In this problem, for example, the product peanut butter is the product peanut butter or is the product fruit jelly. This will depend upon the interpretation that is given to each product category in the HS schedule. The issue for the lawyer is what sources of information will be persuasive to customs collectors in determining the classification of the good. So what you're required to do is, now I told you a little while ago that all the taxes are imposed and collected by the customs. So when you're trying to determine what would be the tariff imposed on this product which is brought from abroad, you might have to sit down and think or list down how would the customs classify this good. That is really the answer to your problem. So under HTS, any fact pattern you must analyze is likely to be case of first impression. So for example, what they are saying is the first impressions matter. So when you take the bottle of peanut butter and jelly swirls, how would you, or as a customs officer, classify this product? Are you going to classify it as under peanut butter and jelly, under peanut butter or jelly, or under peanut butter and jelly swirled together? Thus, there are probably will be no precedent directly on point. So there will not, most likely in most cases, you will not have an example to go by. Dictionary meanings are also not to be determinative. So this dictionary meanings of what is peanut butter and what is jelly will also not help you. So if the above approaches are not likely to be helpful, then what interpretative approaches do the customs officers use in ambiguous and overlapping classifications? The problems of place of origin classification arises when raw materials or partially finished products from one nation are processed and completed in another nation. Now, the example I talked to you earlier about how pistachios that are grown and harvested in Iran are taken to Iraq and taken out of their shells and packed. So that is what they're saying, how raw materials or partially finished products from one nation are processed and completed in another nation. Those are the points that will be important in determining what is the place of origin of that good. The issues are especially troublesome when a multinational enterprise is operating subsidiaries in several nations. And as such, subsidiaries perform part of the manufacturing process. It's difficult for companies, let's say for companies like Nestle, which is a multinational corporation, have subsidiaries in various countries, and maybe they grow cocoa in Brazil, and they take it and make cocoa butter in Peru, and then they send the powder to the United Kingdom factory to make hot chocolate powder. So where is the where can be the place of origin of the hot chocolate powder that is exported out of the United Kingdom to the rest of the world? So those are things which you have to consider and give your opinion on. And each person the customs officer's opinion might be different from your opinion as to where the goods originated from. So if the two opinions are different, the rate of tariff that the customs impose on you, you might feel is unjustified because custom has not analyzed that problem properly, then most likely, and in most of the cases, you end up in courts of law trying to determine whether you have been overtaxed. As we have so many cases in the Court of Appeal in Sri Lanka, where they come constantly, the private parties or the private citizens come and file action against the customs, saying that they have been overtaxed because they have been wrongfully classified. Then the lawyers for the private party will try to show to court how they belong to the classification A and not B, and they will give their interpretation on all of these things based on their reading of the documents. Then the courts will look into that matter, and they will also address their mind to that. And ultimately, what would govern the classification when a classification is challenged is the interpretation that the courts will give to a matter like that. So now we are going to quickly move into the third case study. I hope it's clear what we are doing, because I want you to be able to apply what you know to a problem and see how these concepts are so important and their understanding is important in the real world, really. So the third case study is something that is going to touch on tariffs and non-pervasive barriers or non-tariff barriers to trade. The setting: two clients bring you seemingly unrelated problems. First, Louisiana Shrimpers is a trade association of shrimp industry companies, including shrimpers, processors, canners, and distributors. United States regulation adopted under the Endangered Species Act require U.S. shrimpers to use trawler or turtle elimination devices. Louisiana shrimpers contested these regulations, but lost before the Fifth Circuit Court of Appeal. Now, I told you a little while ago how people go to court all the time. Here is a shrimp manufacturer, or you can say a shrimp trader, who has challenged the domestic or national law on shrimp being categorized under the Endangered Species Act, and that imposed additional requirements or expensive measures on the part of the shrimp trader to use a trawler or turtle elimination device to harvest shrimp and not any other maybe less expensive ways, less costly ways. The Louisiana shrimpers contested this regulation but lost before the Fifth Circuit Court of Appeals in a litigation battle that had environmental conservation groups allied with the Department of Commerce. Louisiana shrimpers, having lost in the courts, then turned to its political allies in Congress. They were persuasive. In 1989, Congress adopted public law which instructed the president to negotiate international agreements to protect sea turtles and to ban shrimp imports which have been harvested with commercial fishing technology, which may affect adversely such species of sea turtles. Now, what did the shrimp Louisiana shrimpers do, they lost in their own courts in their own country to adopt less costly methods to harvest shrimp, and then they could have sold their shrimp at a cheaper price and made a better profit. So what do when they lose their case? They try to lobby with the the ministers and the government, and they get a law passed where now, in terms of this new law, nobody can import shrimp into the United States unless that shrimp has been harvested with commercial fishing technology, which may affect adversely such, the importation is banned if the shrimp has been harvested with commercial fishing technology, which may affect adversely such species of turtles. So what are they doing? They're trying to create an equal or level playing field for themselves with international importers by restricting, or what we earlier learned as non-tariff barrier examples, imposing a ban on certain type of products. In this case, certain type of shrimp that might have been harvested using a technology that is less costly and would place those international suppliers of shrimp in US at a price advantage than they are. So they made sure that they got a law passed which will put them on a level playing field. So, I'm sorry I couldn't go into this. So I'm on the second para of this first page. Specifically, the President must determine and certify to Congress annually whether the government of the harvesting nation has provided documentary evidence of the adoption of a regulatory program governing the incidental taking of such sea turtles in the course of such harvesting that is compatible to that of the United States, and the average rate of that incidental taken by the vessels of the harvesting nation is comparable to the average rate of incidental taking of sea turtles by the United States vessels in the course of such harvesting, or the particular fishing environment of the harvesting nation does not pose a threat of the incidental taking of such sea turtles in the course of such harvesting. So these are very cumbersome things that the government has to get involved in, and the president must annually certify to the Congress that what is being imported are strictly controlled and conforming to these requirements. Shrimp from uncertified harvesting nations cannot be imported into the United States. So that now is a law. The State Department administers the shrimp turtle certification process. At first, they did so without much enthusiasm, but several lawsuits of environmental groups and Louisiana shrimpers pushed the State Department into a broad ban against shrimp importers. Now here is the importation ban we talked about earlier as the first example in non-tariff barriers or NTBs. I'm going to move into the penultimate paragraph in that page. The complaint has been heard before a WTO panel under the 1994 Dispute Settlement Understanding. So far, the United States is losing, but an appeal is pending. You are counsel to Louisiana shrimpers. They are distressed. I'm sorry, I think I missed a paragraph, so I'm going to go back to the third paragraph from the bottom of that page. The State Department administers the shrimp turtle certification process. At first, they did so without much enthusiasm, but several lawsuits of environmental groups and Louisiana shrimpers pushed the State Department into a broad ban against shrimp importers. See Earth Island Institute et al. Was the Secretary of State. Shortly thereafter, India, Thailand, Malaysia, and Pakistan filed a complaint with the World Trade Organization, asserting that the United States was in breach of its GATS obligation. So this is where it led to. So the non-tariff barrier, that is an importation ban on shrimp, imposed by the United States, was challenged by certain countries, India, Thailand, Malaysia, and Pakistan in this instance, as a breach of the goods is the General Agreement on Trade and Tariffs Obligations. The complaint has been heard before a WTO panel under the 1994 Dispute Settlement Understanding. So far, the United States is losing, but an appeal is pending. You are counsel to Louisiana shrimpers. They are distressed and would like to be heard somehow in the appeal process. Assuming the United States loses on appeal, as it did, they want to know what are the consequences of public law. They would naturally prefer just about any alternative you can think of other than nullification of this law. So the effect of losing their appeal at the WTO, dispute resolution mechanism, is if WTO will hold that the United States law, the public law 101162 banning certain type of shrimp harvesting is bad in law and that law should be struck out, then what would happen is Louisiana shrimpers will now have to compete with imported shrimp that had cost much less than they had to endure to harvest their shrimps. So they have a price advantage where they can sell their shrimp in the US market at a price which may be much lesser than the price that Louisiana shrimps can place on their product. So they want your advice on how to tackle this problem, that if the law is being nullified, how they can get over the consequences of that law or the ban not being there for foreign importation. Now, we started off by saying you have two separate clients. Now, the second client's problem. United Ranchers of America is another of your trade association clients. United Ranchers used to export lots of beef to Europe, but that was before the Europeans adopted a law which took effect in 1988, banning the importation of beef from animals treated with fast growth hormones. United Ranchers cashed in all its political credits in supporting a vigorous campaign by the United States to overcome this law. So here is a United States company that used to sell a lot of beef, exported a lot of beef to European Union, until one day European Union adopted a law banning the importation of beef from animals treated with fast growth hormones. So now that affects the business of United Ranchers directly, because now they are not able to sell their beef to make a profit unless they ensure and they certify that their beef have not been from animals treated with the fast growth hormones. So to make a long battle short, the US finally prevailed before a WTO panel and the appellate body early 1998. The appellate body's report is excerpted in the readings for this problem. The United Ranchers is a bit weary, but feels like it won. As a result of arbitration about what constitutes a reasonable period of time, the Europeans had until May 13, 1999 to implement the recommendations and rulings concerned, which still has not happened. United Ranchers would like to know if there is anything they can do to make the Europe adhere in a way that at long last opens up their market to hormone-treated US beef. So United States and these United Ranchers backed the United States to challenge this law in Europe that banned their beef from entering into European Union, and they feel like they, after a long battle, that they won. However, the WTO dispute resolution, the WTO panel told the Europe that you will have time until 1999 May 13th to implement recommendations and rulings concerned, which would take away this law and permit United Ranchers to sell their products to Europe. United Ranchers would like to know if there is anything they could do to make the Europe adhere in a way that at long last opens up their market to hormone-treated US beef. So now the United Ranchers wants you to know that there is anything they can do to make sure that the Europe would ultimately, in 1999 May, would open up their market so that they could start trading again. Meanwhile, in the wake of the mad cow disease, the European Union stopped internal trade in British beef but allowed its export to other parts of the world. The United States quickly and without extensive study banned the importation of all British beef and the beef any other European nation. In announcing this ban, the United States expressed the fear that the disease had or at least could spread throughout the Europe without internal frontiers. This fear is now groundless. In 1998, the European Union banned internal trade in Portuguese beef for lack of adequate BSE avoidance, while at the same time lifting the ban on internal trade in British beef. It is widely believed in the scientific community that the mad cow disease originated when beef carcasses, notably brains, were used in cattle feed. Although scientists are not in agreement, it is believed possible that use of any animal carcasses as feed may also infect live animals. Excuse me. Use of carcasses as animal feed is now prohibited throughout Europe. In the United States, only use of beef carcasses is illegal. There is no doubt that some humans who ate contaminated mad cow beef in Britain came down from Creutzfeldt-Jakob disease. What is much less clear is the gestation period of this disease. Studies in Britain suggested that Creutzfeldt-Jakob is very slow-growing or can lie dormant for years before causing human injury. It is not known how many people may be carrying the disease and whether such carriers can transmit the disease via their blood. The British government has acknowledged hundreds of deaths from Creutzfeldt-Jakob disease. The British have also acknowledged many confirmed cases of infected cattle and have slaughtered millions of cattle in their country. Infected cattle and CJ disease have also been significantly identified in France, Germany, Italy, Spain, and Portugal. More recently, Japan and Canada and the United States are experiencing similar problems. Japan now tests every cow slaughtered in that country. The United States tests way below 1% of all slaughtered cows, with Europe testing about 75%. Sounds a little like the pandemic that we have right now. United ranchers used to advertise that no US cattle have ever had mad cow disease. Naturally, they support the ban against British and other European beef imports. This ban has, economically speaking, helped make up for the loss in revenues from Europe's denial of entry to US hormone-treated beef. The British, however, have recently filed a complaint with the WTO against the US import ban. The British maintain that this ban violates a sanitary and phytosanitary SPS agreement of 1994. The British, being clever, have studied the arguments used by the United States in beef hormones. In addition, the British asserts that the US mad cow disease ban is excessive. They say that only a very small percentage of their cattle ever had the disease, that in source has been scientifically identified and remedied, and that there is no longer any public health risk. And the British have some allies in this complaint. The other European nations covered by the US import ban agree and argue further that they should never have been included in the first place. United Ranchers is beginning to feel like they may have shot themselves in the foot. They come to you seeking advice and counsel for what will undoubtedly be another monumental battle. So, let's see how we can approach this problem and what areas of focus we should address our mind to in solving a real-life issue like this. Multilateral GATT negotiations have led to a significant decline in world tariff levies. As steadily as tariff barriers have disappeared, non-tariff trade barriers have emerged to retard freer world trade. Health and safety regulations, environmental laws, rules regulating product standards, and customs procedures are frequently said to present NTB problems or non-trade barriers problems. It was not surprising before that NTBs dominated the Tokyo round of GATT negotiations during the late 1970s and Uruguay round in the late 1980s and early 1990s. Part A, as in our first problem, explores the United States' attempts at exporting its conservation goals for dolphins and sea turtles. These laws are classically extraterritorial, that is to say, they apply to people and actions located outside the territorial limits of the United States. Extraterritorial jurisdiction is extremely controversial, as we shall also see in other problems. For now, politically charged question is whether WTO dispute settlement and the GATT agreement provide the means to challenge US accession of such jurisdiction in the environmental protection conservation arena. To some, the evolving law of the GATT WTO demonstrates a loss of sovereignty. Others say the shrimp turtle's decision proves that trade law will always triumph environmental interest. I hope you understand what we're discussing. So, GATT and WTO, some countries argue that adherence to GATT and WTO standards stringently would diminish the value of their sovereignty and their ability to rule on matters which would otherwise be considered as rules of as a sovereign state's ability to make laws for themselves. Now they are bound by international obligations. So they cannot impose regulations as and when they like and whoever they like. Whereas others argue in this instance, the shrimp turtle's decision proves that trade will always triumph over environmental aspects. In part B, where you were introduced to United Ranchers, it considers US state European non-tariff trade barriers for beef. Everyone agrees that health protection provisions can be misused for protectionist purposes. Most such measures are enacted without protectionist intent, but with some protectionist effect. There are few such provisions in which all sides will agree. To resolve such disputes, SPS agreements calls upon science to furnish unequivocal data. But most scientific data, like most legal rules, is subject to interpretation and can be argued in several ways. The standards that must be met by the scientific data and the assignment of evidentiary burdens are critical legal issues. Part B presents two scenarios where scientific data is thin. So, what you need to address your mind to in this second, the United Ranchers issue, is the need for scientific analysis of actual impact of these sanitary conditions on the ability to import or export, and how, if there is evidence backed by science, that you can use that evidence to make legal rules which you can then justify. Now, when US export of beef was blocked to European Union, saying we do not want beef that has been artificially injected with hormones, there was a sanitary and a health concern. And then in turn, when it was US's turn to ban beef that were imported from Europe, they banned that on the basis that your countries have a higher number of mad cow disease spreading around across your borders than we do have in US, so therefore we do not want to get beef from yours. Now, whether both or any of those assertions are backed by scientific evidence is what you will have to look into before you advise your clients on how to go about this situation. So if United Ranchers now feel, okay, we have shot ourselves in the foot by banning or by encouraging our country to ban imports from Europe, and now that it will be counterproductive to our needs to export to Europe, you will have to find evidence to show that your ban imposed in US is backed by scientific evidence on PSPs, whereas their ban is not backed by scientific evidence when you actually challenge this in the WTO. So you understand how each of these non-tariff barriers also play a significant role in how we go about dealing with these institutions and how we go about dealing with each country's barriers to free trade, and what an extensive and time-consuming exercise this is. Before we move into the fourth case study, I think we can take a small 10-minute break and then come back. So now it's 10 to 4. I will start at 4 o'clock again. Now we are going to look at the fourth case study. And this is, as I have told you earlier, let me just get this side. It's a case study that will touch on the regional economic organizations and trade regulations and how those will in turn impact on WTO obligations and would work as an exemption from WTO obligations. So the fourth problem, free trade agreements and customs union, Japan's perspective. So the setting, Sunrise Manufacturing is a Japanese multinational corporation driven by the motto, quality is everything. It produces bicycles, especially mountain bikes, in its Osaka plant. For many years, Sunrise has exported high-quality bikes to Europe and North America, but the rising value of the yen hurt its price competitiveness in these markets. United States and French manufacturers in particular have been increasing their market shares at the expense of Sunrise. This has occurred despite the decline under the GATT WTO in Europe and North American MFN tariffs, which has made it less expensive to import Sunrise bicycles. Management at Sunrise has decided that production in the United States and France should be seriously considered as an alternative strategy to exports. Initial tentative plans are to continue the engineering and design of its bikes in Japan. All major components will be made in Osaka. These components will be shipped abroad to the new plants where they will be assembled with just a screwdriver, which of course will be forwarded with the components. In this way, management feels that its reputation for quality will be ensured. Sunrise has read about Fortress Europe and Fortress North America in several Japanese trade journals. It is aware that NAFTA is a free trade area, while the European Union is a customs union. It also has a general sense that each is a good deal for insiders, which it would like to become. Beyond that, Sunrise has lots of questions. For starters, it would like to know what critical distinctions exist between free trade areas and customs union. Is one more preferable than the other form? Its perspectives as a potential foreign investor. What tariffs will Sunrise pay on the components it plans to ship to its French and United States subsidiaries? Once assembled in each location, can Sunrise freely trade its bicycles to Mexico and Canada and to other EU states? In other words, can Sunrise take advantage of NAFTA and the EU regional markets? Naturally, Sunrise would prefer to stick with its initial screwdriver assembly plant intentions. If, however, management is persuaded that high-quality components can be obtained in France and the United States, or for that matter anywhere inside NAFTA or the EU, it is willing to reconsider. Whether it should do so because of the way NAFTA and or EU work is another of its concern. One more immediate problem facing Sunrise is the safety of its bicycles. Accident rates on its mountain bikes have been rising, along with increased litigation and insurance costs. Consumer product safety regulators in the United States and France have begun reviewing the construction and design of Sunrise bikes. The last thing that management wants is a product recall, or worse yet, a product ban on its bikes. The president of Sunrise hopes somehow that production overseas will alleviate product safety regulatory burdens associated with its full line of bicycles. He would appreciate advice on this point. You are a young attorney with a large multinational law firm with offices in Tokyo, Los Angeles, Chicago, New York, Toronto, Mexico City, Paris, London, Frankfurt, Madrid, Rome, and other locations. The senior partner who handles Sunrise as a client has asked you to draft a response to the questions and concerns outlined above. What is your response? So here is a matter that touches upon few things. Rules of origin, local content, regional trade agreements or customs union, rules taking over WTO obligations and tariffs, and whether a customs union or a regional trade agreement like NAFTA is, which one is better than the other. So what should you address your mind to? So I will just read you the focus of consideration, how these authors guide you in addressing this problem. The GATT WTO notwithstanding, regionalization and bilateralization of the world economy has been growing rapidly. The Europeans got things rolling in the post-war Reconstruction era with the Benelux Union, the European Economic Community, now the European Union, and the European Free Trade Area of 1950s. Regional integration spread throughout the developing world during the 1960s and 1970s. This period, for example, saw the emergence of Central African Customs and Economic Union, the East and West African Communities, the Caribbean Free Trade Association, the Central American Common Market, the Latin American Free Trade Association, the Andean Common Market, and the Association of Southeast Asian Nations, or ASEAN. The formation of these groups was motivated principally by the desire to develop economically and to increase bargaining power. Many of these agreements were handicapped by serious political problems. More recently, the Gulf Cooperation Council was formed in the Middle East. The Southern African Development Community emerged after the apartheid. A South Asian Free Trade Area was agreed, that is a SAARC, and a Southern Cone Common Market was established in South America. Many of these regional groups intersect or overlap, and even more pronounced trend, the bilateral free trade agreements. Hundreds of such agreements lattice the world, including, for example, European Union and South Africa, Canada and Costa Rica, China and Chile, Japan and Singapore. Mexico has dozens of bilateral free trade agreements. At this point, the only nation without a bilateral free trade deal is Mongolia. The variety of factors help explain why bilaterals have become the leading edge of international trade law and policy. Difficulties encountered in Uruguay, Seattle, and Doha rounds of the multilateral trade negotiations are certainly crucial. GATT WTO regulatory failures regarding bilaterals have also fueled this reality. Yet, these negatives do not fully explain the feeding frenzy of bilaterals. A range of options or attractions are also at work. For example, bilaterals often extend to subject matters beyond WTO competence. Foreign investment law is a prime example, and many bilaterals serve as an investment magnet. government procurement optional at the WTO level is often included in bilaterals. Competition policy and labor and environmental matters absent from WTO are sometimes covered in bilaterals. So what I'm reading is, in fact, to give you an idea that an agreement or bilateral or multilateral like NAFTA can give you a better deal overall from when countries deal with one-on-one, or in NAFTA's case, 3 countries together, that's Mexico, Canada, and US, that could give potentially more beneficial terms to those countries to deal with those 3 countries or those 2 countries alone than the WTO contract will give you in general. So when you're answering that earlier question about Sunrise as to whether the NAFTA is attractive to you, whether they should get into the NAFTA system, these are the considerations that you should keep in mind. What benefits does the free trade agreement have for you that you cannot get under the WTO in general? Then the laws, then there was another question about whether NAFTA or European Union was more beneficial for them in terms of entering into those markets. This problem focuses only on the major industrial nation that is not a member of the Regional Economic Alliance, Japan. From the perspective of Sunrise, what do all these agreements suggest for its trade and investment interest? Specifically, what are the implications of NAFTA and the 27-nation European Union? So when you consider a question like this, you have to first see what are the benefits that the NAFTA give us as opposed to the European Union. The laws of NAFTA and the European Union are considered in many parts, in many different aspects. Materials designed to introduce the complex EU lawmaking and litigation-oriented dispute resolution system are more thorough. So in this problem, we are primarily concerned with sorting our tariff and non-tariff trade barrier consequences for Sunrise. This will lead to an understanding of basics of free trade area agreements, customs unions, rules of origin, and the significance of regional product safety regulations. So when you're addressing your mind to giving an answer to a question like this, these are your guidelines. How should you approach this question in the realm of international trade law, international trade theory and policies, or international trade concepts? You will have to do a comparative analysis of identifying the best suited and maybe the best arrangement, in the sense of maybe it may not be as vast as in this example. Europe, if you decide to go to European Union and set up your plant, you might have access to 27 nations. Whereas if you set up your plant in, say, USA, and you get access to the NAFTA treatment, you have only 3 markets of 3 countries opening up for you. But is that a problem? Would those markets give you a better chance at pricing your product, that you can cover any losses that you might incur by not opening a plant in the 27-nation European Union? So those are here, what I just discussed with you are a point-based system of how you should approach a problem like this. So with that, we will quickly move into the 5th case study, which is something that focuses on the tariff laws as they apply to developing countries. Now, countries like Sri Lanka, let's see how tariff laws work when a developed nation company deals with a country like us. So the setting here, Import World Incorporation is an Illinois corporation which specializes in importing different consumer goods. For most of them, it pays most favored nation tariffs under the US law. But some goods come from developing nations. The company understands that the Generalized System of Tariff Preferences, GSPs, for products from the developing world have been established. Import World has heard that it may be possible to import a variety of goods duty-free from the GSP as applied by the United States. Company officials would like to know how the United States GSP system works, and in particular, whether and how it applies to imports of leather goods. Leather products account for nearly a third of Import World's United States sale. Naturally, private exporters based in the developing world and their national export promotion boards also are very interested in the answers to these questions. Their economic development plans call for increases in the export of leather goods over the next 5 years. If such increases materialize, it is projected that the hundreds of jobs will be created and that revenues from the leather goods industry will assist in stabilizing balance of payments and debt servicing problems. But they worry about the trade discrimination. Some developing nations are concerned that the Caribbean Basin Economic Recovery Act of 1983, the Andean Trade Preference Act of 1991, and the African Growth and Opportunity Act of 2000 may divert United States imports to Caribbean, Andean, and African sources. Other nations are convinced that Mexico's participation in NAFTA is a real problem. They seek NAFTA parity, which 5 Central American states plus the Dominican Republic obtained under the Central American Free Trade Agreement of 2005. Likewise, Jordan, Chile, Morocco, and Peru also have free trade agreements with the United States, and more US free trade agreements with developing nations are in the wings. Still, others believe that the real threat to their common interests lie in third world assembly plants, which benefit from special US tariff treatment when US components are used. Some wish to compete to attract these labor-intensive investments. Quite naturally, Import World wants to know how the CBI Andean, AGOA, and assembly plant programs compare and interrelate with the GSPs. It is especially interested in their impact on trade in leather goods. So now let's see how this kind of question, which is a little more complicated because it involves the generalized system on tariff preferences or GSPs and regional trade agreements and their benefits, and how one can lobby with the government of a developed nation and try to get the same trade benefits that it gives to another developing country to itself. How all of these questions and points interplay when you have to consider, compare, and give an answer to this a rather complex problem of telling this Import World, a private company, how to navigate this intricate framework of international agreements overlapping with each other. So the focus of our consideration here, we will start with many third world nations have persistently argued that their development needs require special trade agreements. Ideally, they would like all their products to enter developed nations duty-free, while maintaining tariffs to protect their infant industries. And that's what countries like Sri Lanka do. When we go to European Union and fight about our human rights record and try to impress them with our human rights record, we are in fact trying and move the European Union to give us GSP plus benefits. We are in fact trying to get into their market duty-free. But on the other hand, when their products come to our country, we try to impose a tariff on it. So that is a protectionist mentality, which most developing countries feel that they need to do because they are disadvantaged by their status of still being developed or developing compared to a developed country. So I said, ideally, they would like all their products to enter developing nations duty-free while maintaining tariffs to protect their infant industries from foreign competition. But the levels of preference have proven too much to expect. They have more realistically argued for preferential tariff treatment lower than most favored nation tariff levels. Their goods enter developed nations at lower tariff rates allowed by a nation, and even in some cases, without any tariff. But they do not reciprocate and grant goods for developed nations similar special treatments. Their pleas ultimately reached listening ears. Special tariff preferences have been adopted by many developed nations. This problem explores special tariff preferences for goods from developing nations. Particular attention is paid to the generalized system of preferences, the Caribbean Basin Economic Recovery Act, and the assembly plant tariff preferences. In addition to the intended benefits to the developing nations, these programs have created new trade opportunities for importers and complex legal questions for international business lawyers. So when you're approaching a question like this and you try to apply your knowledge on world trade or international trade agreements, here is a problem where you need to consider how you can negotiate your country's position, international development index or international development within international development parameters, and how you can use that status to argue for more preferential benefits for you as a country. But at the same time, I told you earlier when we started how countries impose barriers on each other as a means of reciprocating. Now, for example, I told you how US will ban certain goods from China as a means of punishing China, and how China will reciprocate by imposing a ban on the United States. Purely to reciprocate, not because they need to, but just as a means of reciprocate. But in developing countries' perspective, we expect, as in Sri Lanka, we are a developing country, so we expect richer countries or developed countries, like countries in the European Union, United States, United Kingdom, maybe Russia, maybe Australia, we expect certain benefits when we try to enter their markets on the basis that, look, we are still a developing nation. We don't have the same resources or the deeper markets or deeper financial markets as you do. So our cost of production, our ability to source financing, they are still at a very infancy level or at an intermediate level where we have a long way to go. So give us a special treatment, give us duty-free entrance to your market. And most of the time, if we achieve in getting that. But do we reciprocate? Now let's assume that we gave the 27 European nations, they gave us GSP plus and duty-free entrance for our garments. Now in return, do we reciprocate in the same terms to the countries for our imports from the European Union? Most often, no. Simply because we are on the arguments rise out of the level that we are developing, and we need to protect our infant industries and domestic industries. Therefore, we cannot allow you to enter to our country duty-free, sometimes maybe because your products can also be higher quality. And if you enter our markets, your products can kill our industries. So we are not in a state where we can allow or we can permit the same level of reciprocity for your goods just because you allowed us a duty-free entrance. So these are really political arguments which go hand in hand with the trade law and policy. So with that, let's move into the last case study, which is a very short one. but which touches upon the non-tariff barriers for which there is only a partial solution. So case study number 6, the setting. Photocop Incorporation is a New York corporation which produces and aggressively markets high-quality photocopying machines. All of the materials and technology necessary to photocopy machines are derived from the United States sources. About 60% come from New York sources. Photocop has sold primarily to wholesale concerns and to corporations, and recently hired a representative with considerable experience selling to governments, a market Photocop wishes to enter. Bids on public contracts for the supply of photocopying machines have recently been submitted to City of Los Angeles, California, State of New Jersey, several United States federal agencies, the Danish government, the Japanese government, and Pemex, the state oil and gas monopoly of Mexico. There are numerous other producers of photocopying machines. Some are based in the European Union and Japan. Photocop's new sales representative has told the directors and officers that its prospect of winning these bids will be affected by a variety of laws establishing preferences in government procurement for local producers. Before committing large resources to this endeavor, Photocop would like you to evaluate whether and how these laws may apply to these bids. So let's see how and what we need to take into consideration in answering a question that seems large on domestic, on the understanding of domestic and national laws and their relevance vis-a-vis the international agreements. So the focuses of consideration: a number of non-trade tariff barriers, codes, sometimes called the side agreements, emerged from the Tokyo round of GATT negotiations. The United States accepted nearly all of these agreements, including the procurement code. Most of the necessary implementation of these agreements was accomplished in the Trade Agreements Act of 1979. However, despite notable amendments to the Procurement Code in 1987, the Omnibus Trade and Competitiveness Act of 1988 amended the Buy American Act and the Trade Agreements Act in ways intended to reduce the degree to which the United States waived its procurement preference. Congress clearly was not happy with the way the code was working. So here we are talking about the policy in the United States, which is happening all across the world right now due to COVID-19, is buy local kind of policy. So here they are talking about how the GATT negotiations led to the side agreements for a number of non-trade barriers, and how even though the World Trade Organization is providing for free trade, movements like Buy American or Buy Local are creating a stir within their own countries to prohibit free trade on the grounds of promoting locally made goods, as we can see in this procurement example. A new procurement code was negotiated under the auspices of the Uruguay round. This WTO code is one of the few plurilateral agreements, which means that it applies only to nations that opt for its coverage. Relatively few WTO members have acceded to the procurement code. These include European Union nations, Aruba, Canada, Hong Kong, Israel, Japan, South Korea, Norway, Singapore, Switzerland, and the United States. The code was ratified in the United States through the Uruguay Round Agreement Acts of 1994. The WTO Procurement Code expands coverage to include procurement of services, construction, government-owned utilities, and some state and local contracts. Various improvements of the procedural rules surrounding the procurement practices and dispute settlement attempts to reduce tensions in this difficult area. For example, an elaborate system for bid protests is established. Bidders who believe that court procedural rules have been abused will be able to lodge, litigate, and appeal their protest. The United States have agreed, with few exceptions, to bring all procurement by executive agencies subject to federal acquisition regulations under the code coverage. So here what we're talking about is, once you adhere to the procurement code of the WTO, you have to open up your procurement to international bidding. Whatever government procurement things, now governments procure materials regularly for day-to-day functioning. For example, from photocopying paper to office equipment, to tables and chairs, to even building and construction contracts for government buildings. It's called the government procurement agreements. Now, the WTO at the Uruguay round tried to enter into an agreement that required all government procurement in the member countries would be open and competitive international bidding. And those bidding mechanisms or tender procedure procurement mechanisms could not give preferential treatment to their local contractors or traders or business people if those preferences are not given to the international players. So it is a huge obligation for many developing countries who want to promote their own SMEs or their own traders or contractors and provide employment to their people in their own countries. Because let's say, for example, the Lotus Tower, if we were signatory to this international WTO government procurement agreement, the government of Sri Lanka would have had to call for international bids and would have had to have the same qualifications requirement for all bidders for construction of the tower, and those qualifications might be better arrived at by an international company who has more experience in bidding for construction of towers than our local industry. So in that way, our local industry might miss out on maybe its only chance to build a tower as tall as Lotus Tower and as complicated as it is. And in that way, our contractors or our construction industry would miss out on an opportunity to get an experience of a lifetime, or create opportunities for jobs, create opportunities for technical knowledge, knowledge sharing and technical knowledge advancement, in not being able to get an opportunity to build a tower like that. Of course, that's not how that tower happened, but I'm just taking an example. So in this photocops example, it opens up an area where the world has not been quite comfortable. Each country has not been quite open and free and ready to enter into agreements as they have been with trading of goods and services. Government procurement agreements at a multilateral level remains an area that most countries have chosen not to enter into for various reasons. Now, my example about the Lotus Tower would give you a reason that the need to protect the construction industries of a country. Now, that day, somebody asked me this question about the Chinese laborers working in the construction industry in Sri Lanka, and what kind of rules that applies. So these are concerns that a government will have to take into serious consideration and take the stakeholders' views into account before it signs a multilateral agreement like the WTO government procurement agreements, because that would impose an obligation for violation of which, if you violate those obligations and give preferential treatments to your construction industry people, that you might end up being sued at the WTO by a private construction company or an investor or a private business party in another country, say like China, saying that here Sri Lanka have been a party to this multilateral treaty on public procurement. However, Sri Lanka has acted contrary to the provisions and obligations therein and has given preferential treatment to their local constructors or constructors from a different country as opposed to us. So it's a very interesting area, but in an area that is hasn't reached the same depth and breadth as the agreements on trade and services has not reached yet. So that ends, I hope this exercise of going into discussion of these case studies had managed to give you a little insight as to how these theories work in real life, or how these theories and trade law and concepts work when we try to put it down into a problem solving mechanism, and I believe would have given you a better glimpse at the importance of these things. So I need a little break. I've been talking for a while, so I'll probably take a 10-minute break, and then we will come to the last segment of this course on international trade. I briefly want to touch upon some of the documents that we use in international trade. So I'm going to take, now it's 4:37, so I'll see you at 10 to 5. So welcome back to the last part of our course on trade, where we take a peek at the financing of, or rather the documentation involved in financing of international trade, what we generally call as documentary credits, or you would have heard letters of credit. Now, what amounts to documents of credit or letters of credit, and what is the principle that governs the documentation, the legal principle that governs the documentation? It's only a small, this is an introductory course. I'm not going to go in depth into this, but I'm just going to introduce these documents so that you would know that these are the ones that exist as a principal method of payment in international trade. It's not the only one, but these are the principal methods of payment. So sellers and buyers have opposing interests, as you would understand. Buyer does not want to pay before he is in possession of goods. Now that is important, and can examine whether they are in conformity with the contract. Obviously, if you had, for example, if you had ordered size 10 male shoes from, say, Egypt, size 10 male leather shoes of a certain design, you don't want to pay as the buyer who's in Sri Lanka the moment the seller says, okay, I've loaded the cargo into this ship bearing such and such number or name, and it has left the port in Cairo. You are not gonna want to pay to the seller at that point, because you want to know first whether those are actually size 10 shoes, and two, whether they are consistent with the design that you have agreed on, and most importantly, whether they are leather. So the only way that perhaps you would think the only way that you can verify that is if you are in possession of the goods. So until then, and until the time that you have inspected those goods, you will not want to pay as the buyer. So that is your main consideration. Of course, there are different ways that the world trading community ensures that these conditions are met without the buyer actually seeing the goods. but we're not going to go in depth into those, but I'm only highlighting the concerns of the buyer and the seller at this point. So the seller also do not want to dispatch the goods as long as he is not certain that the agreed price will be paid. So the seller also wants to be sure that before he boards the goods to the ship and send it out of the port of his country, he wants to know that there is some sort of assurance as to that he will get paid when the buyer receives the goods. So how do you balance these different concerns is what the documents of credit or letters of credit try to address. Because of the distance, the unfamiliarity with each other, the buyer and the seller, and different trade practices in different countries, obviously, these opposing interests could make international trade very difficult, as you would appreciate. However, systems of documentary credits called letters of credit helps to reconcile these diverse or divergent interests. Letters of credit is the most frequently used method. Like I said, it's not the only method, but the most frequent method to pay for goods in international trade. So what is a letter of credit? It can roughly be described as an arrangement in which the bank acting for and on behalf of the buyer, that is the customer, so it's the customer's bank, undertakes to pay the seller or the beneficiary a sum of money, or to accept a bill of exchange drawn by the seller, or to authorize another bank to do so, on presentation by the seller of a specified document and on condition that all other credit terms are met. So it is a document that has its own, a letter of credit is a document that has its own conditions, and it is a document that the bank of the buyer or the one who has the payment obligation opens up and undertakes to pay the seller or the beneficiary upon the seller satisfying those conditions by presenting the documents that are mentioned in those conditions. So what is a bank's role in issuing this letter of credit? The bank of the customer, which has opened a letter of credit for the beneficiary, that is the seller, is called the issuing bank. So the personal undertaking of the issuing bank is evidenced by the letter of credit. Which contains full undertaking and sent to the beneficiary. The issuing bank shall pay when specified documents are in conformity with the stipulated conditions and are presented on time. So the issuing bank is the bank of the seller, and they will pay to the seller upon the seller submitting documents which are in conformity with the stipulated conditions as in the letter of credit. So there's another bank, the advising bank. In most cases, the issuing bank shall authorize a bank, there's a typo there, bank established in the country of the beneficiary to examine the specified documents and to negotiate, accept and pay the beneficiary's draft. This latter bank is called advising bank. I'm sorry, I think here there is a mistake. It should be the bank of the customer which has opened the letter of credit for the beneficiary seller is called, I made a mistake here. The bank of the issuing bank is a bank of the buyer who has opened a letter of credit for the beneficiary is called the issuing bank. So the personal undertaking of the issuing bank is evidenced by the letter of credit, which contains the full undertaking and sent to the beneficiary or sent to the seller before the seller dispatches the goods. The issuing bank will pay the seller when specified documents are in conformity with the stipulated conditions and presented on time. So the buyer's bank or the issuing bank will authorize a bank established in the country of the seller to examine the specified documents and to negotiate, accept or pay the beneficiary's draft. The second bank is called the advising bank. So for example, if Bank of Ceylon in Sri Lanka opens up a letter of credit for a customer or a buyer in Sri Lanka who wants to purchase a Toyota car from Japan, that bank will be called the issuing bank. So they will issue a letter of credit which will have certain conditions that will mention certain documentation that the seller in Japan has to produce to the bank. And if those documents or those conditions are fulfilled, the seller in Japan will get paid when the conditions stipulate that he should get money. That would be either loading the car to come to Sri Lanka, or when the car is accepted at customs, or when it arrives in Sri Lanka, or something like that, depending on the conditions. So the Bank of Ceylon in Sri Lanka will want a corresponding bank in Japan, let's say Mitsui Samurai Bank in Japan, to be the advising bank. They will they will advise the bank in Japan, the Mitsui Samurai Bank, send them a copy of the letter of credit and say, so and so, the Toyota Corporation in Tokyo will produce these documents. Please check whether these documents are the correct documents that are mentioned in the conditions to get paid. And if so, the issuing bank will transmit the money to the advising bank, and upon the conditions being correctly adhered to, the advising bank will pay the seller once the buyer receives the goods, or as agreed between the parties in the agreement. So how does the letter of credit work? So you can see in the first two cases, the buyer and the seller, or the importer and exporter. First, there is a sales contract. A contract or agreement to sell and an agreement to receive. It's called a sales contract. Second, the buyer will have an issuing bank, or the importer's bank. That agreement or the request from the buyer to the bank is a request for credit, where they will ask the bank to issue a letter of credit. Then there's an agreement between the issuing bank and the advising bank. It's called, it's for sending of credit. So the buyer gets credit, buyer deposits money and asks for a letter of credit from the issuing bank. The issuing bank in turn will contact the advising bank. Then the advising bank will deliver a letter of credit to the seller, in our early example, to the seller Toyota in Tokyo, Japan. They will deliver the letter of credit. Then what happens? Then the seller delivers the goods to the buyer. That's point number 5. Then upon delivery of the goods to the buyer, the seller presents documents at number 6 to the advising bank. And upon documents being received, the advising bank will send the documents, copies of that, to the issuing bank. And the issuing bank will produce all those documents to the buyer and ask for money to pay to the seller. So this is actually practically how this whole thing works. It's not too complicated, but it is important that we understand the mechanism of how a letter of credit works. Because in fact, there is no, almost 99% of the time in international trade, there is no exchange of money from buyer to the seller's hands. It is always through letters of credit and through banks on banking system or banking network internationally. Here, I want to show you a small clip in trying to understand this concept. I think it's very important, and this clip, it is made by a certain company to promote its businesses, but I feel it explains this whole scenario nicely in a very short time. So let's just listen to this.
I'm Sam, and I want to tell you all about letters of credit. And along the journey, this might even help your clients. Did you know SMEs account for 99% of UK businesses, and 46% of them experience some form of cash flow problems? Most of the trade in the world is done internationally. In order to facilitate this, a business needs to have trade agreements with their partners and counterparts. Trust is incredibly important when agreeing payment terms. Putting this on a scale, at the riskier end, trade can be done on open account terms, where the risk of the seller bears the risk of not being paid. A letter of credit, or LC, is less risky, and in this video, we'll explain why. Here at Trade Finance Global, we help companies find debt funding in the market with various financing structures to meet businesses' needs. We want to help you explain debt terms to your clients and help grow your clients or help recognize future cash flow challenges. A letter of credit is relevant where there is an exporter and an importer, and there needs to be prepayment or confirmation of payment in order for goods to be shipped. A letter of credit is an instrument from a bank which guarantees a buyer's payment to a seller if certain criteria are met. If the buyer can't pay up, due to the agreed contract through the letter of credit, the bank will cover the remaining price. Letters of credit are fundamental components of international trade. They're governed universally by a set of guidelines called the UCP 600, which are issued by the International Chamber of Commerce. So, what is a letter of credit? An LC is a promise written on a legal document that comes from a bank with a promise to pay the holder if the holder fulfills certain obligations. Obligations include payment when the goods are shipped if certain criteria are met. A letter of credit is usually used when the buyer and seller do not know each other very well, and this is why it is used so frequently in international trade. Letters of credit are incredibly specific, and a close attention to detail is required. If there is a misspelling in the contract, for example, the name of the goods is incorrectly spelled, there may be a non-payment until a new corrected LC is issued and accepted. So, what are the advantages of LCs? For the buyer, they are certain to receive the goods as stipulated in the letter of credit, and they do not need to pay for the goods up front. For the seller, they're somewhat protected against non-payment from the buyer. There are lots of different types of LCs, and I'll cover most of them today. Often, people get confused between commercial letters of credit, which act as a primary mechanism for a transaction, and the standby letter of credit, the secondary payment mechanism, a fail-safe guarantee. Depending on the perspective of the buyer or the seller, there are also import letters of credit, set up by the importer or buyer of goods or services, and exporter letters of credit, which are set up by the exporter or the seller. So how does a letter of credit work? On behalf of the buyer, the issuing bank promises payment to a seller or beneficiary. An advising bank may act on behalf of the seller. The advising bank will receive payment, normally when they have been presented with specified documents representing the supply of goods. So, why are letters of credit used? They're safe. Letters of credit are usually legally binding, and so all parties need to agree to cancel them. They offer clarity. The goods defined in an LC are specific and well defined, so the details of the transaction are generally very transparent. They offer risk reduction. The exporter or payment to the seller is guaranteed payment, providing the terms of the LC are met. They allow for safe trading. Letters of credit are a focus of international trade and allow companies to trade safely in unfamiliar markets with unfamiliar suppliers. They're efficient. Letters of credit can be raised electronically using an online trade banking service. There are several different types of letters of credit. I'm going to cover a few of them. The irrevocable letter of credit allows cancellation or amends to the letter of credit by the buyer if the buyer's bank, seller, and/or seller's bank agree. A confirmed letter of credit is a second guarantee by the seller's bank. It adds additional security for the seller. It means that if the issuing bank from the buyer fails to make a payment, the seller's bank agrees to guarantee payment. A transferable letter of credit can be passed from one beneficiary to others.
They're commonly used when intermediaries are involved in a transaction and others are supplying the seller in the transaction. A letter of credit at sight. These are payable as soon as the agreed documentation has been presented and verified. Deferred or usance letters of credit means that the payment to the seller is delayed until an agreed period of time has passed. A red clause letter of credit permits the seller to receive partial payment from the issuing bank prior to shipping the products or performing the services. So how is payment collected on letters of credit? To receive payment, the beneficiary must present documentation of completion of their part in the transaction to the issuing bank and must present documents such as invoices, bills of exchange, or government documents. Thanks for listening to this talk on letters of credit by...
Okay, so that was a brief but a very comprehensive introduction into letters of credit. I just only want to, I know he highlighted 4 types of letters of credit, but the most important for us to know as people who are just taking a peek into international trade is the irrevocable and revocable letters of credit. Because any type of letter of credit, whether it's transit letter of credits or letters of credit that are issued at the spot, letters of credit primarily, or LCs primarily fall into 2 categories. All the letters of credit primarily falls into 2 categories. One is either they are revocable or irrevocable. A letter of credit must clearly indicate its nature. In the absence of such indication, it is deemed or it is presumed that the letter of credit is irrevocable. That means it cannot be changed. Only an irrevocable credit offers the exporter, the seller, the necessary guarantee of payment. A revocable credit may be amended or cancelled by the issuing bank at any time and without prior notice to the exporting beneficiary. Irrevocable letters of credit are rarely used in international trade for this reason, because they can be cancelled after the seller sends the goods or boards the goods into a shipment. When the goods reach or before the goods reached the buyer, the buyer's bank can cancel the letter of credit. For that uncertainty, because that it's so risky, irrevocable letters of credit are almost not used in international trades. I'm sorry, I think there's a mistake. It should not be irrevocable letters of credit. It should be revocable letters of credit are rarely used in international trade. Even with irrevocable letters of credit, the beneficiary has to wait till the bank accepts the documents as conforming in terms of the credit, and only then the beneficiary will be certain of payment. So, in a nutshell, this is what the main instrument of international trade for payment or financing is, a letter of credit. And these are the rules or the legal obligations that govern these letters. So now we have come to the end of this course, and I hope it had been very useful for you, or in giving you just a peek or as an eye-opener for international trade and some of its main concerns. So,
hi, this is Nikita. I have a question.
Yes.
Do we require a collateral to open a letter of credit?
I'm sorry, I couldn't gather the first part.
Do we need a collateral to open a letter of credit?
Do you need a what?
Collateral.
Can you type it, because I'm not very clear with that word only.
Okay.
Oh, can you spell? Yeah, I got the message, I think. Collateral. No, you don't. No, you don't, because the banks will only now, for example, when you're importing a car from Japan on a, let's say on a permit, the bank will open that letter of credit, but give you a certain number of days, like 45 days, within which you need to deposit that money in the account. right? So that letter of credit will have that as a condition. If by this number of days, if the buyer fails to deposit that money, this letter of credit will expire. So a collateral is not essential, and it is not mandatory, and it is not required in certain instances. But different banks could have different policies. But in international trade, it is not mandatory to have collateral. But however, that will be reflected in the conditions or in the legal basis of issuing that letter of credit, and the seller will know this, that the buyer has this number of days to submit or to forward or to deposit that money for this letter of credit to be effective.
Okay.
Have I answered? Yeah.
Yes, thanks a lot. And the other one is, so how can the banks earn profits by issuing a letter of credit? Do they charge?
Yeah, there's an interest component added by the banks into it. That is like, for example, People's Bank and Bank of Ceylon, they have a service charge, and there is a what we call hidden bank charges. There's always a service charge and a processing fee that is attached to these letters of credit, and that I believe translate into profit.
Okay. And my last question is there a particular time limit for an advising bank to pass the letter of credit to the seller or the beneficiary?
There generally is, but it varies. It is mentioned in the letter of credit itself.
Okay, thanks a lot.
Okay, so finally, I just want to wrap up all the topics that we have covered in this 2 days lectures. So we had looked at, we have analyzed initially the decision to trade. As you need to understand that the trade is, first and foremost, international trade is a decision that each country has to make, and on a certain factual and policy basis, they have to take an affirmative decision to enter into international trade. Because we have discussed over the course of 2 days that there are not only positives, but a lot of negatives that attach to a country's development if it engages in international trade. However, I, of course, personally hold the view that it's no longer open for countries to wait and restrict and close its borders from international trade, because you're only going to miss out on the benefits of trade, or you're going to miss out on the benefits of globalization. So on the first day, we did a case study, and we did that case study. I put that case study to you with the hope that you will understand why countries feel the need to trade and how they arrive at their decision to trade. Then we examine after the case study, we examine the trade theories and policies. How have the trade theories and concepts developed over the course of 2 or 3 centuries, and where we are now. Then we learned about the developments that led to the creation of the World Trade Organization, which is the body, the international body that regulates trade in the world. Then we learned today about regulation of international trades and through trade barriers and non-trade barriers and their impact on free trade. And finally, we took a peek into financing of international trade, and more specifically to the aspect of letters of credit. So I hope this course has been useful, and you will have gotten at least a basic knowledge of what international trade is. And I wish you all the best in the rest of the programs that you have for this course, and good luck with your future endeavors. And thank you very much for participating in these lectures. So thank you, and